Okay, welcome everyone to another Sunday session, one after our long macro outlook there in the end of October. And as much as we think that every macro outlook or every week is going to give us clarity, it seems like we just end up waiting for another week or another month, and there's just so much going on, so many data points, and maybe it's just a sign because the Twitter community and the oil and gas community has gone big over the last little bit. But I also think there's just a general factor to it because from my time in the oil markets pre-COVID, yeah, there were deals, yeah, there was M&A, there was interesting things going on and volatility, but not to this extent where people were watching every EIA report, people are watching every API report, every crude export data out of OPEC, every single Chinese demand number, and watching flights every day and drilling rigs every day. So something's definitely changed, which is good. It makes things exciting, and it allows us to sort of get an edge depending on the way you interpret the data going forward. So I think there's a question there. Somebody wanted me to go through a quick WTI review. So I think I've mentioned this on some Twitter spaces, but a lot had to do with the expiration of the December contract, which is the most traded contract. It's also the contract with the most open interest usually. So the options and the futures on that expired last week, followed by the general OPEX options expiry on Friday. And then the December 22 contract itself expires, WTI contract expires on Tuesday, I believe. So a little bit more expected here. On the paper market side, we had the same thing last November, and it was hyper volatility last year because of Omicron hit at the same time. We're also going into this long weekend, so some of the demand data can get a bit skewed, as it sort of always does. But we'll sort of take it as it comes. I did want to talk about a couple things that I really look at, because it's going to be likely a lull period for the next 2 to 4 weeks. Not really much going on. People are looking at the data, trying to understand which way things are going, and a couple of factors: the SPR, the Chinese demand, and then the Russian barrels are top of mind, along with OPEC cuts. Let's not forget that the OPEC cuts had started in November. So how much are they really cutting? When OPEC first announced this in early October, people were speculating that it's going to be this many barrels and that many barrels. So let's see what it actually is. So before I begin on the Vortexa stuff, the SPR, 7.5 million barrels out of the 10 that were supposed to be released in November are already out. So that's till November 11th. So for the last 19 days of November, realistically, there's only 2.5 million barrels left for the entire 19 days. So just over kind of 130,000 barrels per day, which sounds very, very low. So I'm curious to see what happens for the next 2 to 3 weeks. I'm expecting the SPR number to be below 2 million for all 3 weeks, and might even be below 1 million for one of the weeks there. So one to definitely watch and see how commercial inventories react. Here we've exited our build season, we've exited the refinery maintenance season. So if the refineries pick up at the same time, there's this 3-week pause in SPR, could be a good sign to drain those commercial inventories, 10, 15, 20 million barrels to more normalized sort of levels, normalized to where we should be for this sort of oil price. When we look at Russian exports, not really a declining trend discernible so far, but if you just look at the last 2 months, there is a bit of a slowdown here happening in the last 4 to 5 days. Why is it important to track this daily? Because winter is hitting Siberia. A lot of Russian oil fields are in the Arctic, in the harsh winter climates. And as we see that the daily high goes below 0 degrees Celsius, it is going to get more imperative to see what happens to this crude production. So When did that happen? That happened about a week ago. So about November 12th, November 14th is when the daily highs started going below 0 degrees Celsius, 32 Fahrenheit, the point at which water freezes and oil becomes very, very heavy, harder to move, especially if you have a sustained downturn, a sustained down period for that oil pipeline or well or refinery, whatever. So watching this very closely. The other one we have, if we look at the sort of not just Russia, but we want to look at OPEC plus, which includes Russia. So we'll throw OPEC plus in here and just let the data update. And November is sort of the interesting month because the November cuts are hitting. So we need to know how much did the barrels really drop. So we'll look at maybe the last 6 months, and we can put it by month. So departures, we gotta include the intra because OPEC does ship some, OPEC plus does ship some to within itself as well. Sort of muddies the data a bit, but it gives us a general trend. So when we look at October, which was the high month, September, October, we were at roughly 30 million barrels loaded per day, right here, down here for the month. When we look at November so far, it's about 27.75. So about 2.25 million barrels down month over month. But the November data for today and yesterday is a bit skewed. So I always add about 750,000 barrels to this number that's loaded for this month. So you add the 750K and I can run through why that is if people are interested here. But it's down to about 1.5 million barrels per day, month over month. That is way higher than people were predicting. People were saying 750, 600, 800. It's more than double that. And the latest data that I saw out of Bloomberg or Reuters that came out said that they were on track for 1 million barrel per day reduction. We're even above that. So watching this trend closely as the month goes on. But if OPEC plus exports do go down by 1.5 million barrels per day, it is a rubber stamp there, checkmark seal that they're serious. They are serious about maintaining a certain stability in the markets. They are serious about proactively cutting production as opposed to reacting to where the oil prices are going. So definitely important. The other one that I often look at is, and I've posted this a couple of times, but we'll look at Chinese crude imports. So let's let it load here. So with China, we're looking at arrivals, not departures. So we'll switch that up right here. And again, one that I'm tracking almost daily, there is a lot of noise in the data. The day-to-day is not that important, but the overall trend over a kind of like a rolling 7 to 14 day period is really what the interesting part is. So we already see that October was sort of the high month, going back to, where are we here? Hang on. Arrivals, next month. Yeah, so I'm going to change this. It's actually not the origin, but the destination needs to be China. So why is it so slow today? So for China as the destination, arrivals for the last 6 months, and we see October much higher than the last few months. And if we go back to a 12-month period, we can see that October was sort of the high point of the last little bit, at least all the way back to before we had the big COVID lockdowns right after the Olympics. So right here's October, 348. We're sort of back to these May, March highs, all the way back to last year's highs. October did have 31 days, so we have to account for that. When we look at November, if we look at the last, let's say, 2 months, and we will put it by split by the day. So the exact date, give us a better idea of the day-to-day trend. You can sort of see the ramp up occurring. So we need more data than that. We'll go last 6 months and last 6 months, put it by day, and the trend becomes much more obvious as to what's happening. And I think a trend that's more important to watch than what's being said on the news, what people are going out and saying in conferences, is not really that important compared to what's actually happening. So you see the upwards slant on this from June, July onwards, sustaining this higher level as well. This last data point is not accurate because it's for today, and the day hasn't ended yet. So sustaining higher, looking good. We're seeing Chinese imports looking good. We're seeing the Russian exports flatlining to dropping, and we're seeing OPEC being serious. So in the face of all that, when crude drops by $12 or $9 last week, you almost got to wonder, okay, this happened last November as well. The contracts are expiring. This is not a time to get complacent and just say, this is just what happens. But when the data agrees with what the idea is as to why WTI dropped, it gives me a lot of confidence in saying these things and in staying in the trade with my equities going forward here. So that's that. I will shut that off. And yes, the next OPEC meeting is in 2 weeks, December 4th. So we'll get some more color as to what's happening. Also, yes, the harsh weather is a technical issue where you can sustain production with the limited services that are left there, with the limited expertise that's left in Russia. But it's when the winter hits and when things start going down that you really figure out, can the people on site get these things figured out, not just from a technical standpoint, but from a project planning and critical thinking and problem solving standpoint for 10 million barrels per day, because that is a large volume that needs to be sustained. So I will kind of end that there on the WTI sort of quick thoughts on there. Before I begin the Zoom session, a couple of things up front. If you are on the Twitter space and you would like to join for the Zoom, whitetundra.ca, scroll to the bottom under events. The Zoom link for this session is on there, and you can join us for the visuals. If not, the Twitter space will stay running. I am not an investment advisor, so everything I share today is my own experience, my opinion on the way I'm interpreting data, interpreting publicly available well data from the Alberta Energy Regulator and the Alberta government. And please do your own due diligence. And please check your risk tolerance and your portfolio construction. Just because I have things set up a certain way doesn't mean they're going to work for you. So those three things are very important, especially in the oil sector, where there's macro and then there's the micro analysis on the companies and their assets themselves. The Zoom session is recorded. It will be put on YouTube here shortly after the session ends. Also on the website, and the Twitter space, I believe, just will save. I think it's being recorded. Yep. So that will be there. I also have a mailing list. I forgot to send this session out. It was just a bit too late to send it out. So I will be sending the future sessions out along with any news releases, presentations, anything that goes with that, along with the Zoom link. So if you do want to be on that, please just shoot me an email or a DM and we can get you on there. And yeah, I think that's about it. There are a couple of other things up front, but I'll talk about them as I sort of go. So we did do one of these sessions before where we discussed the PetroNinja wells update. I didn't want to repeat those ones. So if you're looking for a certain company or a certain field, they may have been covered in that session. I want to say sometime around June, July, I think we had that one. And then I really wanted to dive deep into Surge Energy and their technical sort of expertise, what they're doing here, and the recent acquisition. a point of very polarizing debate. Some people are saying, well, it's good, some people are saying it's bad. But until we really have the full data and facts as to what they bought and why they seem to keep buying these sorts of assets, it's difficult to make a proper conclusion and have a good discussion around it. So I hope in the following sort of Twitter spaces, maybe some of this will be discussed with a little more technical backing to it going forward. So that's where the idea came from. I want to do these every 3 to 6 months. I think deep diving into a certain asset is just interesting from somebody who's investing in these, and also to create some idea generation going, because I think a lot of people are just saying, well, it's Viking, it's Clearwater, it's Montney, and it's all the same thing. But there's differences between the basins that makes certain assets more attractive in a low price environment. There's certain assets that are more attractive in a high price environment. There's certain ones that have a lower decline rate. Some have a better growth profile. So knowing these things is going to be very important going forward if you really want to be a very detailed oil and gas investor. And the reason I say that is because so far it's been sort of a momentum trade, the rising tide lifts all boats kind of mentality. But going forward, when we're not seeing companies 2, 3, 5, 10x in a year, the really strong companies are going to differentiate themselves. And those companies are not the same in an $80 environment. They're not the same in a $120 environment. Management credibility is going to get different values depending on the macro. So the macro is first. You need to have a good understanding and a view of the macro going forward. Then we can go to the asset by asset reviews and say, okay, this company has these value levers they can pull, and therefore they're going to do well in this climate. These companies, I'm happy with them doing acquisitions because XYZ. These companies should not be making acquisitions because they have a 40-year reserve life already. So why are they making acquisitions, right? So just framing the entire investing thesis. If you're a short-term trader and you play charts and you play technicals, you may not find this all that interesting because none of this, I don't think really matters in the day-to-day term. Okay, so we'll get the slideshow started. So, okay. And yes, we will have Paul, the CEO of Surge, on Twitter Spaces. I'm hoping early next month. I am kind of tied up here for the next little bit. So I'm thinking early December is going to be a good time as well for that. So yeah, so we'll start with the PetroNinja Wells update, and then we'll go into the Surge asset review. So some ARC wells, ARC resources in the Montney. ARC resources being one I really focus on their well results because they have some of the most degraded acreage in the Montney through their 7 Gens acquisition. Now, when I say degraded, I don't mean that it's rapidly falling off a cliff. I mean it's the most mature asset of this size in the Montney. And we need to take learnings from what happened in the Bakken, in the Barnett shales, in the Eagle Ford, and in the Permian, to then say, how is the Montney going to evolve over time? And ARC Resources gives us clues as to how the rest of the Montney is going to evolve. How much tier 1 acreage really is there? Previous shale plays have started to get really degraded when 60% of tier 1 acreage has been drilled up. So is ARC there yet? We don't really know, but the well results have been dropping. The average productivity of the well from 2017 to 2019 to 2021. But is that trend going to sustain, and is it going to accelerate are really the questions. So here we have kind of a generic ARC resource as well. So we see about 3 to 4 MMCF of gas, so about 600 BOEs of gas there. And then the condensate rates are looking pretty good, between 400 to 600 barrels per day. We're looking at another well, a little bit lower productivity. So I really like focusing on these wells because you almost think, okay, whoops. It's a bit early yet, but really trying to track what the IP rates are, IP30, IP60, IP90, IP180, IP365. We got to compare them one by one to each and see what sort of degradation is going on. So the nice thing about ARC, they drill wells all the time. So we have data coming in all the time. So far, the wells are looking good. We have some latest wells here that are looking really, really good. 7 to 8 million of gas and 600, 700, 800 barrels of condensate. You know, a very exceptional well in these sorts of pricing environments where WTI is 80, condensate is trading at $2 to $3 above WTI, and then natural gas is getting 4, 5, 6 an MCF, and ARC Resources having access to the Alliance pipeline and various other egress offtake agreements, including an LNG contract coming up in a few years, that they can really make this play work. Even if the wells are slightly degrading over time, they become much more economic compared to a 2017 well when condensate was $50 and gas was $1.50. Yeah, so red is the gas in million standard cubic feet per day. The pink, this darker pink, yeah, they kind of made them the same, but the darker pink is your condensate, and then one of them, I believe, is a sales condensate. So after some of the condensate has dropped out or been used for other purposes, I will have to verify that because these two lines look almost exactly the same. And yes, it's daily production rate. So this is month 1, month 2, and month 3. This is just other data from earlier. And if we go back here, this is month 1, month 2. So month 1 is always a half month or a partial month. So the data is not that accurate. Month 2, the well could still be cleaning up a bit. And then month 3 is when we really start saying, okay, this is actually good data, as we see here. Same with this well, looking really strong, like 6, 7, 8 MMCF of gas per day. That is really strong for a Montney well to sustain on. And a good sign for ARC that they still have the meat on the bone left. It's not that they overcapitalize this thing and it's going to fall off a cliff compared to some of the other acreages that I have discussed in the past. So that's it on ARC. I think really I focus on the Kakwa Car asset that they bought off 7 Gens. It's the real money maker, the big liquids generator until Atachi comes online in we'll see when, I guess, hopefully sooner than later, as this Blueberry First Nation issue kind of resolves itself soon here. So Baytex, I mean, absolutely exceptional. These Baytex Peavine wells were making 600, 700, 800 barrels per day, and they were the most economic wells in North America. And you know, we were all saying, "Wow, this is amazing!" You know, these Baytex wells are so good, and they've got these sections, and they've got the agreement with the First Nations there, so there's no problems. And now these wells are coming on at 1,000 barrels per day with 8 to 10 legs, $1.2, $1.5 million drills coming on at 1,000 barrels per day. These would be like less than a month payout. So they'll pay out in less than a month, and then they will probably end up paying out like 6 to 8 times in the first year. And this is what makes these wells so much better than a shale well, because a shale well may pay out in 3 to 4 months. By the time it pays out a second time is going to be 12, 16, 18 months, and it may never pay out a third time. Whereas these conventional, multilateral, low-cost drilling operations can end up paying out multiple times. And after that, you do water flooding on it, and maybe this well pays out 30, 40, 50 times over its 20-year lifespan. Huge net asset values, huge NPVs. And as this goes on, expect to see this reflected in the year-end reserves report, depending on how much drilling Baytex can get done here. Here's another well, 1,100 barrels per day in September, like absolutely crazy what this thing is making, and almost no water to it. So there's no water disposal cost yet until they maybe get into some water flooding optimization. But this is just phenomenal. What has happened in the Clearwater is really something to watch, because this multilateral drilling has been going on for 4 or 5 years, and then it got brought into this Clearwater, and it just completely changed the game. The Clearwater has gone from 20,000 to about 120,000 in, I want to say, 2 years, 2.5 years ish, 2 to 3 years, let's say. So really good economic returns. The question now is, how extensive is this acreage in the Clearwater? And we saw Headwater just drill 2 dry water wells in their shadow area. So maybe it's not quite as extensive as people were thinking. That being said, a lot of exploration still to do, very, very early stage on this. And the other thing is, this sort of technology is not just applicable to this area. There are many, many conventional fringe reservoirs that may become economic, may become commercially producible with this sort of technology. And what makes it even more interesting is it's relatively cheap. So if somebody had $10 million, they can go and drill 6 to 8 exploratory multilateral drills in various parts of Alberta. And all they need is one of them to prove even like a 200 barrel per day well, not 1,000, just 200 barrels per day. And all of a sudden, you may have delineated a very extensive field there. So as capital returns to the sector, watch for companies to take stabs at multilateral drilling on the fringe edges of their acreage and in some random land that they have sitting around in certain places. Yes, so the multilateral wells go vertically down, and then they have 8 to 10, sometimes up to 20, 30 legs extending horizontally from the same vertical. So not all the companies are covered in this, Greg. So only the notable wells of certain companies. I shared which companies on the latest Twitter post. The other companies do have important wells, but not something that's game-changing or something that I really want to discuss. But hopefully the next one, there's some other ones that sort of pop up. I will say Athabasca is drilling some really good wells at 2 creeks there in the Montney and the Duvernay. So should come up on the next one here. Once I have a bit more data on that. I see Razor here with his cat. So a little bit more on the Baytex Peavine. We don't just want to look at the first couple months. We want to look at sort of a 4 to 5 month period, and the decline rates are not that bad. The well has gone from, this is a logarithmic scale, so the well has gone from 600 to 500 to 400 over a 3 month period. Once again, that's really good, because it's probably paid out 1.5 times already in 3 months. We look at a more extended well, even this one is doing really, really well. So this one came on in April, and April, May, June, July, August, September, 6 months, and it's still producing 600 to 700 barrels per day. So very, very attractive economics here. Baytex has a lot of sections. If they can extend out this Peavine, there is Tamarack that's now trying to get into that area. So if Baytex can really prove out this area, they really are onto something, especially if you can then do a water flooding on it, which we'll find out how effective that is in this part of the Clearwater here going forward. So the question is, how accurately does seismic find these wells? So you can have seismic, you can have logging, you can have coring, you can have all sorts of things. The Headwater shadow wells look really, really good on the logs. Everything looked really good, really promising. They had, in fact, I believe, wanted to do a 4 or 6 well program, and they ended up moving the rig after 2 wells. It was that bad. And that obvious that area had straight water. So you can tell up to a certain point, but if it's going to cost you 1.5 million, a lot of people just go and drill it. It's just, let's see what happens. Let's see what comes out of it. Sometimes you find oil, and the oil is immobile. It just doesn't want to flow into your wellbore, into your production equipment. And then you just sort of leave it there until some other technology comes in where you can do various things. You can inject polymer, you can do steam, you can do, people are doing radio waves downhole to heat the oil and all kinds of things. So just because you find oil doesn't mean it's a good, successful economic well. And I will show a couple examples of that here later on. So that's Baytex. I'm very happy with how things have gone there. I think they have a new CEO, they have a new CFO, and a new COO, if I'm not mistaken. So very, very excited to see where they take the company, because it's very open to them. They've got 4 really strong assets, and they all compete for capital in an $80+ oil environment. So really interesting to see. Now, the Clearwater, people were talking about Delta Stream, about Spur, about Headwater, Baytex, etc. We knew CNRL was going to come to the party. CNRL has so much land all over the place. They just wait, they watch, they monitor, they see what's going on. They have a huge presence in conventional heavy oil, in the chops, heavy oil with produced sand sort of formations. They've got batteries everywhere. They've got pipelines everywhere. They've got processing terminals everywhere. And now they're on the scene. They now have the second best block of acreage after Baytex. So the Smith acreage, it's not that massive, but the wells are coming on really good so far, what we know. About 500-600 barrels per day here. We have another one, came on in August. It's now at 521, a bit more water up front, but completely manageable. And we look at one that came on in June, very strong, almost no decline rate with the September data. So we have about 400 to 500 barrels. Again, these things pay out in 6 to 8 weeks at $80 oil. And if you want to run it at a higher oil price, you can see how the net asset value just becomes like out of the world, because you're running a low decline, long life asset on a higher price deck going forward. Okay. So another one on Smith, 600-700 barrels per day. I mean, CNRL just does everything right. They wait for people to prove out the acreage, take some risks. They themselves take some risks, but not to the percentage of company value that other companies are doing. So they'll sit there, they'll just watch. They already have the land, they already have the acreage, and then they go and buy more, buy whatever they need to take people out and build upon that. So another one, so not every well is successful. This well that CNRL drilled in Smith is about 120, 150 barrel per day well. It's still going to pay out in 5-6 months. So, I mean, they're not complaining by any means, but you can't just run your model saying every well is going to be a 500 barrel per day well, because they're still trying to understand the edges of the pool and maybe some discontinuities in the pool. There may be some geologic differences in the pool. So it's always better to run a modeling where if they're drilling 10 wells, we say, okay, 3 of them are going to be a lower quality well, and maybe 1 is a complete failure. Maybe it's a water well, it doesn't hit oil, whatever reason. So because it's still early in the Clearwater. That being said, these wells could get a lot better. If people figure, well, we can do 14 legs, we can do legs in a wine rack method, we can do legs in a different orientation, we can start water flood right from the start. Whatever they think and try, there's the optionality that the wells get even better from here going forward, because it is open hole, uncased flow. So it's unrestricted, and it's not reliant on any fracs. It's just reliant on the properties of the reservoir and the oil in its most a natural state without increasing any permeability with what you're doing. So CPG in the Bakken. So Crescent Point has been very, very popular, active in the Bakken. They do these horizontal frac wells, and this is kind of one of the latest one because the field is getting pretty beat up. It's getting quite matured. So 135 barrels per day out of this single horizontal frac well. And why is it important? Because Crescent Point has now started to do multilaterals on the edge of the Bakken. A lot cheaper because you don't need steel for the casing, and a lot cheaper because you don't need to frac it. So these wells are coming on at 100 barrels per day, 107 barrels per day. So a couple of things, much more economic, much faster internal rates of return, and it extends the pool. So the edges of the pool that people had said, well, these are never going to be economic, may have now become economic. So what does it do? It adds reserves, it adds drilling inventory, and it gives you the opportunity to just maintain production in a field rather than blowing it down as you run out of drilling inventory, as you run out of locations, and the acreage gets worse. So there's been 3 of these wells so far, including Cash Island, which is Scott Saxberg's new company, Scott Saxberg being the ex-CEO of Crescent Point. So obviously had his eye on the area and is now going in and drilling these wells. And Crescent Point is following them because they literally operate in the same area. We'll watch to see how this goes. It's not just Crescent Point that has their eye on this. The Bakken in Saskatchewan is massive. The extent of it is absolutely phenomenal. So if some part of the edges become economic, or you go and do multilateral infill drilling, you go and drill it between, there's 3 horizontal frac wells here, you go and do a multilateral right here, and maybe you enter a zone of high permeability because of the frac already. So evolving, it's very evolving, which is why we're doing this update, to get the ideas going on things to watch for as technology goes on. Yeah, you don't need casing because it's open hole. You're not fracking through any casing in the horizontal section of the well. So you just leave it completely open as long as you're not worried about formation collapse, which shouldn't happen anyway if you're not destroying the rock. Things stay pretty stable downhole. Yes, this is the Viewfield Bakken Zendoc. So yeah, this is exactly what you're talking about. So Crescent Point Frobisher. So we'll talk about some Frobisher wells going on, but definitely want to watch. These Frobishers can be very economic, and Crescent Point is still doing a really good job. These 169 barrel Frobishers are going to be like a 3-month payout at $80 oil. Saskatchewan, a relatively nice royalty regime and easier to operate with the amount of expertise and infrastructure in place. Lots of water, but that can be disposed due to the infrastructure in place. Duvernay. So the Crescent Point Duvernay, there are some problems with getting the data here with the way that well production is reported, the NGLs, the condensates, the propanes, butanes, etc. But looking pretty good, 3 to 4 MCF on the gas. And I just compared to other wells in the Duvernay that are making this much gas. Really, really good. And they have recently entered the Duvernay and made some technological changes, made some engineering changes. The Crescent Point team is one of the most technically focused team out there. So they will make improvements to whatever asset they end up buying. They will make improvements to currently existing assets. So definitely keep an eye out for these Duvernay wells. They provide some more color on their quarterly results. I'm more interested in the decline rates going forward. So how do these decline over a 12, 24, 36-month period? Crescent Point might have come in and done longer laterals, bigger fracs, different well spacing. So now we need a new type curve for these sorts of wells. Just because a well made a higher IP90 doesn't mean it's a better well. In shale, the decline rates and the EUR, expected ultimate recovery, are very, very important factors for these sorts of wells. So now let's get Crew a bit. So Crew Energy, again in the Montney, a bit further northwest in the Fort St. John area. So there is a session coming on that, Dirk, about explaining water flooding, explaining production and whatnot. I don't know if you can read the little whiteboard back there, but there is one session that I've said I need to do one on the basics of production, disposal, and all this. So it is coming. But so the Crew NGL wells, these are not liquids-rich condensate wells. These are high NGL content, natural gas liquids, propanes, butanes, not the pentanes and the pentanes plus, C5 and C5 plus. So 6 to 7 MCF of gas, we have about 140, 160 barrels of NGL. Very good for that sort of area. Another well in that area, about 7 million standard cubic feet of gas. That is about 1,000 BOEs per day of gas, and you add in a bit of NGL on it, increases the economics, especially when propane price is looking good. Septimus, this is more liquids rich, condensate rich. I don't know why it's saying NGL. It's actually C5 plus, so pentanes here. Again, a reporting problem with the way this thing is reported in Alberta and BC. So 5.6 MCF of gas, call it about 800 BOEs per day, but making a lot more condensates, 400 barrels per day of condensate, which trades again, $2 to $3 US above WTI. So getting a premium here. It's a market that's in continuous supply demand shortfall, just the way that condensate is required to dilute the oil sands going into the US. Yes, the Columbia session is also upcoming, Gabriel. Another one in Septimus, so really good. Like the Septimus is a liquids-rich area. Why do I focus on Septimus? Because Septimus will tell you how good Monias is going to be and how good Tower is going to be. So we have a couple results from Monias already that are proving similar. And then Tower, we only have 2 or 3 wells, and there's a 6-well pad being drilled, I think as we speak or shortly here. So the more liquids-rich Montney that a company can prove up, the value add is absolutely insane on doing that. So if we have one liquids-rich area and we map out the trend of that liquids-rich basin, we can say, okay, Septimus has this economics, Monias and Tower are going to be close. Monias has 600 drilling locations possible. Tower has 150. There you go. It added this much value to the NAV of the company at this point in time. So all this data is already out there. We don't need to wait for production results to go and say this area is this good. The reserves evaluators will not give you credit for it until you do that. But we can front run the reserves evaluators by saying, okay, these wells here are this good. This is in a geologic, stratigraphic, same zone, same logs, same everything. It should be somewhere between 75 to 100%, 75 to 125%, the type curve of this. It's not science, it's not exact science, it's a mix of science and a bit of imagination and art and subjectivity. But you can choose to not do it, or you can choose to do some modeling and have some idea of where things are going around that. Yes, I will be speaking about that company at the Columbia session. It is a microcap, so very interesting insights we get from companies like that, for sure. So the other one that Crew has recently discovered is Crown Birch. They just drilled wells to keep their land, and they were like, oh, we're just going to drill land retention wells and see what happens. Well, they ended up discovering a absolutely crazy gas play. So 11 MCF per day, it comes on at. A year down the road, it's at 7 to 8 MCF per day of gas. So very low decline. Low NGL, it's not a liquids play, it's a gas play, but 11 MCF of gas is roughly 1,600 to 1,700 BOEs per day per well. And at a $4, $5, $6 AECO environment, very, very economic. And there's upwards of thousands of locations that crew has in Crown Birch, very contiguous with CNRL, with Shell, and with Strathcona. So more value add. And the reason I bring up crew is differentiating NGL-rich acreage, condensate-rich acreage, and then dry gas acreage. Each has a different value. Each is attractive to a different type of company in a buyout per se. Each has a different reserves associated with it, and the optionality. If gas prices go to $8, $9, $10 AECO in 2 years, as LNG Canada is coming online, well, here you go. Now you have 1,000 dry gas drilling locations that are this productive. If gas continues to stay down a bit, you go and drill Septimus, you go and drill Tower, you go and drill Manias. Some companies have this optionality on capital that is not really well understood. It's not well modeled. I've given companies some flack on this in the past, like a Baytex, for example. Why are they going into East Duvernay? I understand you're trying to delineate this. You just did the Kaybob Duvernay, so you're all interested in the Duvernay, but those wells are nothing compared to a Peavine or even a heavy oil play at an $80, $90, $100 price environment. So something to watch the way your companies allocate capital going forward. Because to me, it shows, it may not be 100% accurate, but it kind of shows what management is thinking. Are they in a value development phase? Do they still want to allocate dollars to exploration? Do they want to prove out plays? Do they want to grow these plays? Like what is the thinking? It's not clear sometimes based on what they're going to tell you in the presentations, in the conference calls, but you see the way they allocate capital, and it becomes more of a story that you can then create and possibly reach out to management and say, look, this is what I think is happening. Am I completely off base or am I accurate? And they're not going to tell you 100%, but they'll give you an indication of how warm or cold you are to that sort of theory. Yeah, so the way it works is when you buy land, you don't actually get the land, you get the mineral rights associated with that land. And the government doesn't just want people to go and buy all of Alberta and then just sit on this land forever, waiting for things to happen. So they say, look, you got 3 years, you got 5 years, you got 10 years, depending on the location where it is within Western Canada. And you have to drill a well or 2 or 3 within that time frame to keep that land and extend it for another 3, 5, 7, 10 years, whatever the number is. So yes, it is a use it or lose it kind of thing. Yes. Yes, correct. Yeah, they don't own the mineral rights. In almost every single case, the E&P companies don't own the mineral rights. They're just leasing them in a way for a certain time period. There are certain royalty companies that do own the mineral rights on their own time period. So one more on crew in the dry gas area, a bit of a longer decline curve. When you see charts like this, don't just look at the first year decline rate. Look at the 4-year decline rate. So this is 2020. Obviously, it was shut down during COVID and then restarted in November-ish of 2020. So about a 4-year period. And you can see that even after 4 years, it's still making 4, 5, 6, 7 MMCF per day. Really, really good for economics on a shale well. You usually see way more declines than this on a shale gas well. So really good. They're onto something here in this Crown Birch-ish area. And if they can get low decline shale gas wells, as LNG Canada comes online, as Albertan internal gas demand keeps rocketing up, and they have thousands of these locations. Very attractive company as an investment. Monias. So this is the crude map. Here's Groundbirch, dry gas. Here's CNRL, Strathcona. This is your Septimus, dry gas. Here's your liquids-rich Septimus, and here's the tower, which I discussed. And here is Monias. So in Monias, they had a well drilled 4 or 5 years ago using older technology that was just sitting there doing nothing. So they went in, they tested it, and they saw that the condensate rates are looking really good. So this doesn't even show up on the PetroNinja data because they didn't flow it into some sort of permanent facility. They must have flowed it somewhere and then trucked it out, and then it got allocated to a different well. Not exactly sure what happened, but it's important to read corporate presentations as well, along with doing your own PetroNinja wells analysis. So what they found is this well is liquids rich as well. So now let me show you the basin geology that I'm describing. This is a liquids rich sort of belt. This is a gas belt. So we don't have any drilling results in Monias and new ones. We don't have any drilling results at Tower, new ones. But when they're doing a 6-well pad here, I am quite confident the liquids ratios here, the condensate gas ratios are going to be really good. And I put that into my model going forward. It also gets put into the 8 times free cash flow model to bring it back to those price targets. Because when I put in my production growth number on it, and I put a net back on it, I'm going to put a higher net back than their existing production. Because their existing production is X amount of gas and X amount of liquids. The new wells are a much higher liquids percentage, so you have to allocate for that with a higher net back. Liquids are worth much more than gas, even in a $6 AECO environment. Okay, lots of questions here. Yes, Dirk. Always correct. Yes, yes. This is Crew Energy. Yeah, for sure. Yeah. So right here is the ticker that I'm talking about on the left. So enough of that. Enerplus in the Bakken. So I've been ragging on the Bakken for a while that it's a mature basin, it's a mature asset. They need to figure out what's happening. And Enerplus has done something completely bizarre where their well results are actually doing really good. So this is not PetroNinja, this is off Novi Labs, but something has changed compared to the rest of the operators. Enerplus is drilling really good wells in the Bakken. So there's a reason their stock price has held in really well. There's probably a reason they wanted to exit Canada to focus more on the Bakken and the Marcellus shale. So something to watch, curious, both from a supply-demand standpoint, from a US supply-demand standpoint, and a company standpoint. Just because there's 40 companies in the Bakken or there's 40 companies in the Montney, doesn't mean you can just compare them as like, oh, they should all be valued at this. Some companies have way better acreage, way better well results. So in a high inflation environment with supply chain problems, picking companies with better wells and better acreage, if you're not having to overpay for that upfront, is going to be a good investment thesis. This is my opinion, not my advice, this is my opinion. And that strength or that alpha generated from doing that becomes exponential if oil and gas prices go up. Because you're getting better wells, you're getting better rates of return, you're getting lower decline rates, and the wells themselves are just that much better. So you're producing more liquids and more gas in a higher oil and gas price environment. People don't believe where oil prices are headed quite yet, but depending on your view there, this is something that's very, very important to think about over the next month or 2 or 3 or 6. Obsidian. So Obsidian is drilling some wells in the Viking. It's a newer play for them. Viking wells used to be good around 80 barrels per day, 75 to 80 to 90 barrels per day. They are now drilling Viking wells 125, 140 barrels per day. So quite good, very economic. Viking wells are cheap, Viking wells are predictable, and Viking wells are cookie cutter. Once you have one, you just slap on a drilling program and you do 100 of them, no problem. There's not really much going on, especially in these more southern Viking plays. So looking good. Here's another Viking well, 175 barrels per day. So one to watch. This change is one to watch. Viking wells used to never make over 100 barrels per day. Very rare, the odd one would make it for a month or two or three, maybe 120 would be your top. Now Viking wells are making 175, 150. I saw the RBC top Viking wells report in September. There was a journey well making 260 barrels out of the Viking. So latest drilling technology, latest fracking technology, and the latest seismic and data collection technology. We don't hear too much about this because nothing has really changed from a new invention standpoint, but there's been step changes over the years that are being applied to fracking in the shales. Now that technology is making its way back into the Cardium, it's coming into the Viking, it's coming into the Bakken, and other places where these acreages are not that attractive at $60, $70, $50 oil, but at $80, $90, $100 oil, to have this much development acreage of the Viking that now pays out in 4 to 6 months at call it $90 oil, and pays out in 2 to 3 months at $100, $110 oil, now becomes very attractive. It has a very similar economics to a heavy oil play. Because the Viking operating cost is just higher, there's not that much left. It's a very thin slice reservoir for the most part. So watch this, definitely watch this. Many producers have land in the Viking, Crescent Point, Baytex, Whitecap, and now Obsidian. So very interesting, very interesting as a conventional oil engineer. I guess I really enjoy seeing these step changes as companies have money to now spend on taking a stab here, taking a stab there, spending $2 million on this. Investors may not like it, but I think it's a really good use of capital, especially if you're debt free and you're already paying a dividend. Instead of going and doing acquisitions, you might as well go and spend $10, $15 million and go drill 7, 8, 10 wells and see what happens. Use aggressive fracs, use a different well spacing, use a multilateral, use a wine rack method, use a different geosteering. Lots of upside to be had. Cardium, so the Obsidian Cardium wells are doing really good. Pretty heavy decline rate on them, so not all that pleased with that part of the equation, but strong Cardium wells compared to where they used to be pre-2016, pre-2018, where they would come on at 200 barrels, 300 barrels. Now we're getting these 400 barrels per day wells. Blue Sky. So Obsidian is also doing multilaterals in the Blue Sky. And look at this well, just amazing. So came on at 800 barrels per day, and about 6 months, 7 months down the road, it's still producing 300 barrels per day. This well has likely paid out 3 times in 7 months, 2-3 times, maybe 2 times, because this is a bit more complicated well. And as long as it produces at this, and they can use this to grow more of these, fantastic, because they have so much acreage in this Blue Sky area that they could just continue to doing this, and heavy oil, lower decline, high netbacks. It doesn't always work out. They drilled 2 here recently that did not do well. You saw the stock price drop about 25% in 2 days because the wells didn't pan out. There's 2 wells that were on the edge of the blue sky. The formation collapsed on them, and they had some reservoir deliverability issues. 50 barrels month 1, second month, 9 barrels. Here's the second one of them, 4 barrels, 10 barrels, 7 barrels. Lots of water at an uneconomic well. Here you see the 2 of them, how they're on the edge of where they've been drilling these multilaterals. I believe one of these was a really good one that produced the 700-800 barrels per day. Pinecliff, known as a dry gas company, they are drilling absolute monsters in the Pekisko. 400 barrels per day oil wells. Remember, this company only produces 20,000 BOEs per day, 22,000. A lot of that, the liquids, is NGL from the gas they produce. They have very little actual oil production. So when I see them drilling these Pekisko wells, and they've got not that many drilling inventory, but enough to sort of keep it going and go do some land grabs, make some acquisitions. 400 barrels per day, that's 2% of their production now. More is liquids. I think this must have doubled their oil production, just this one well. And it's hanging in there. It hasn't dropped off too bad. Granted, we're only 2 months in, so definitely watch, see what happens here as the months go on. Here's the second Pekisko well, 528 barrels. 3 months in, it's still producing 400 barrels. So for those who are avoiding Pinecliff as a dry gas company, but you're happy with the dividend, you're happy with the valuation, you're happy with management, and you want a little bit of this unknown catalyst that the market doesn't really talk about. You know, people talk about Pekisko wells, yeah, but not the fact that their liquids production or their oil production has gone up like 5x in the last little bit. Well, maybe not 5x, but 2 to 3x. And the corresponding change that makes to the cash flow. When your liquids goes up that much, the liquids make 5 to 6 times the amount of netback per BOE. So your cash flow jumps 15%. And they're drilling more of these. So watch. One thing to definitely watch going forward. Here's another one, the third Pekisko well. Pretty good, 500 barrels. A little bit of a higher decline on this one. I think it's had some well runtime issue as well, but a little bit more gas here for sure. Here's an older Pekisko, so one that came on earlier this year, about 7-8 months down the road, it's still making 200 barrels per day. So quite good, really quite good, and about 1,000 MCF of gas. So another 150 BOEs of gas, nice. We'll probably take these all day long from a dry gas company if they can do this. Okay, hard to put a value. So before I continue, I'll just say for anyone on the Twitter space that wants to join for the visuals, the Zoom visuals, whitetundra.ca, scroll to the bottom under events, the Zoom link is on there, and you can join us for the actual pictures. If not, the audio will continue on. I can only take questions on the Zoom just because of the way it records. So if you do have any questions, please join the Zoom and we can take the questions through chat on there. So Pipestone in the Montney, another company that just got absolutely trashed after their Q3 results. And the wells aren't all that bad. They're a bit more sour. They're having some problems with infrastructure. The production operations may not be the best, but the wells themselves are still really good Montney wells. I believe it's still making 400 barrels of condensate in their middle part of the zone. That got a big no to it from investors. I think there's other problems with Pipestone that are unrelated to the well results with the share counts and whatnot. But Now, the thing I wanted to show here with Pipestone is look at the wells here. This well, so September, August, July. The well came online in July, sometime in July. Look when the well was spud. They started drilling this well in January 30th, and it didn't come online till July. So for high growth Montney companies, don't be alarmed by the capital cost getting a bit out of whack and the production not matching up with it in certain quarters. Pipestone suffered from this, and Obsidian suffered from this, where the production didn't make sense with the capital that was being put in, but there's this delay that is not really well understood, and it wasn't well explained. You know, let's not take management's blame out of this. It was not well explained as to what the delay was, why it occurs, and why it's not really going to happen, or it is going to happen, because that's just the time it takes from the spud of a Montney to bringing it onto production. So just things to keep in mind. There's a bunch of high growth Montney producers out there right now, Kelt, Crew, Pipestone, Spartan Delta. The capital doesn't always reflect production until 6 months down the road, especially in some areas where you can only drill in the winter because of the marsh swamp environment that these wells are in. Prairie Provident, so a company that is relying on new wells to really see how well it's going to survive going into this bullish outlook. Banff wells, they drilled some of these Banff Michichi wells. The IP30, as you see, is about 250 barrels per day, and then declining to an IP180 of like, what are we at here, of roughly 120, 110 barrels per day. And why is it important? Because the new management team came in and said, we're making changes. We're making engineering and geologic changes. Okay. So the old management team was drilling wells like this. They were trying to target this Banff, upper Banff zone, and these detrital facies. The new management said, it's not that productive doing this. You're better off drilling lower and hitting the entire Banff that has a higher porosity. Okay. So what are they saying? They're saying the IP30 should have gone up 17%. The IP365 should have gone up 19%. And the EURs have gone up 27%. Okay. When I first talked to Tony here, this is what he mentioned to me back in, I believe, May or June, somewhere in there. And I said, okay, depending on how well he's correct on this is how much trust I'm going to add or remove from what I know about this company and the new management team. So, okay, let's see what happened. IP30, they're saying 131 barrels per day. So let's go back. Yep, they hit about 250. So definitely something is being changed. The IP365 is about 81 barrels per day. Okay, so we just said the IP, call it, where am I here? The IP 180 is roughly 110 barrels per day. Right now it's making about 60 barrels per day. So let's say for the next 6 months, it makes an average of 50 barrels per day. So 50 for 6 months, 110 for 6 months, average them out, you get 80 for an IP365, which is sort of exactly where they had predicted. So the type curve is a little bit more slanted, where it's a higher IP30, and then it normalizes to the same IP365. The next will be to see the type curve. Does it actually increase the type curve 27% on the oil, which we're going to see. Where does this Banff well normalize? Does it normalize at 40 barrels? Does it normalize at 30 barrels? Does the decline stop at 20 barrels? That's going to tell us the indication of the expected ultimate recovery. This is how they graph it. You graph oil rate versus cumulative oil, and you see what is the total expected recovery when the well eventually dies at 0 barrels per day, and the type curves associated with that. Here's another Banff well, one that was drilled earlier. Looking better. This is a better well. This well, green is oil once again. It produced over 300 barrels per day oil for 3 months, and almost a year down the road, it's still making 70 barrels per day. So this is going to absolutely go. Now, hang on a second. No, this is not the Banff well. This is a Glock well. This is a Prairie Providence glauconite that they had drilled, which really, really helped the company. And I don't know why I don't have the Glock map in here, but these are very thin river channels. So it's this channel that goes up. You drill horizontally in the channel, and this well really helped Prairie Providence this year. They are now drilling 2 more. One is already online, and I believe 2 more next year. So we'll see. Are these glauconite there? Is their remaining glauconite inventory as good as this one? So Banff, Michichi Banff, and glauconite, the 2 plays that are going to make PPR or break PPR, and really need to watch what they're changing and how the results are coming out. Okay, so yeah, so there are some to come. So Armin, I did the PetroNinja wells by alphabetical order. Not every company was covered. So just certain notable wells were in the P. We still have 4 or 5 companies here, and then we'll go into the surge update. Yeah, I don't think you want to hear my thoughts on that, Ray. Yeah. And yes, yeah, PPR is one to definitely is one that's on the edge. So they are getting close to the bank loan. Prudential is a very different sort of lender depending on which kind of Prudential you're dealing with, the big companies or the small companies. And with the small companies, they are relatively cooperative, collaborative, and we'll sort of see how this company goes along. I have a meeting with management this week, so I will have an update as to what's happening. Their hedges roll off at the end of the year here, so they go from getting $64 a barrel on 1,000, I think 1,200 barrels per day, to now getting 80, 85, 90 going forward. So it makes a huge difference. But the well results need to be good. They cannot afford to have bad wells right now. It's just out of the question. Because if you have a bad well and you spend $2, $3, $4 million on it, not looking good from your cash flow perspective going forward. So I'm glad the Michichi well is looking good, and the one older glauconite well is still hanging in there. Pretty decent gas rate, pretty decent oil rate. Spartan Delta in the Montney, amazing, absolutely amazing what they've done. There's some really cool companies in the Montney that are drilling exceptional wells, and I wish I could own them all, but I just have to pick one at this time. So we see here about 5-6 MMCF of gas. The oil rates are 500-600 barrels per day, very strong. We look at another one here, which is just crazy. It's 7 MMCF per day of gas and almost 1,000 barrels per day of condensate. We're getting up to rates that were previously unseen for liquids IP60s in the Montney. So whatever this team has done, absolute kudos to the team there, and bodes really well for Spartan Delta going forward as they delineate, as they develop, as they go and do some exploration, and they decide where to build gas plants and how to take this company forward from here. And I think these sorts of well results, once they hit the desks of the Permian producers, EOG, Marathon, ConocoPhillips, Chevron, Exxon, should bring some interest where they say, well, hang on a second. These Montney wells are making over 1,000 barrels per day and 7 MMCF of gas, so about 2,000 plus BOEs per day. And they've got how much acreage? They've got 300 sections of acreage like this. Okay, let's check our game plan out here, and what are we actually doing here? Do we want to stay in the Permian and Eagle Ford, or do we want to go into the Montney? It's going to take a bit of time, but this is early stages of these kinds of wells being drilled. And I've discussed this one before, a geologic marvel that I love discussing. It is a natural fracture in the Montney. So certain parts of the Montney have natural fractures. So there's a Montney A, a Montney B, and a Montney C. What companies usually do is drill one of them. So they'll drill into the Montney A or the Montney B, produce it, and then they'll see, is the Montney A or C productive? Let's drill a second one there. Some places in the Montney have a natural fracture. So the Montney A drains into the Montney B, drains into the Montney C. So what you do, you drill in the Montney C, frack it, and you produce the Montney C. And in the meantime, the A and B keep draining down just because of gravity and pressure. Things are going to flow from high pressure to low pressure. As you drain that gas and oil, your well becomes a low pressure zone. The bottom or the top zones drain into that. So let's see what's happened 4 years down the road. Usually Montney wells decline 70, 80, 90% in year one, and then another 40, 50% thereafter, 30, 40, 50%. This well in 4 years has only declined 75%. So it's declined in 4 years what a Montney well declines in 1 year. So very exciting, very, very exciting, very exceptional economics. It's a shale well that has a net asset value of a clear water well, but way better because it just produces higher rates for longer, and the gas to go along with it. And it's almost flatlined. You see how it's almost flatlined at 250 barrels per day? It's just going to produce this forever now. Very low decline rate on this because the structure of the reservoir just keeps draining as it goes on. So I know people were complaining earlier this year when Spartan Delta increased their capital budget twice. They said, we're going to do this, and then we're going to go drill in the Simonette. The reason they're going to Simonette is because it's very close to this natural fracture. And they want to figure out, okay, Sequence, when they were drilling there, may not have figured this out. But we now have the land, we have the infrastructure, we have the expertise. We'll go and drill, pop a couple holes or two and see what happens. If we find this kind of natural fracture that extends out, you could have 30, 40, 60, 100 locations that you then drill like this, provides you that stable cash flow, which then feed your machine going forward, even in a Montney shale development. Yeah, very, very cool. Like this is a one that is different. It's just different. It's not your typical Montney well. They're also drilling really good gas wells in Ferrier. So Cardium gas wells, I believe these are taken from Bellatrix. So 11 MCF per day on a gas well in West Central Alberta. Really solid. And yeah, it declines, but with higher gas pricing, once again, optionality. You want your companies to have optionality to reallocate capital to certain places. I'm not saying every company needs to have that, but it is a nice little bonus when you have it set up this way. And multiple companies are set up this way. NuVista, Paramount, even like a Cenovus, for example, Spartan Delta, where, okay, so we have this cash flowing asset, and then we go and have this growth asset. So the Bellatrix assets are Spartan's cash flowing assets with really good results. And then the Montney is a growth asset that then gets fed from all this free cash flow and grows production. Yeah, so I don't have all the details around Prairie Provident, and I am meeting management, like I said, this week, tomorrow actually. So once I have that, I can share more on Twitter Spaces, but I don't want to speculate and I don't want to make conclusions because there's no benefit when I'm literally discussing with management tomorrow. Clearwater. So Tamarack's Clearwater looking really good. 200, 300, 400 barrel per day wells, decent decline on them. There's a reason Tamarack entered the Clearwater. Yes, they overpaid. You cannot say that they didn't overpay. They definitely overpaid because they had an indication of what's happening, that the wells are really good and the wells are water floodable. So let me go back here. A non-water flooded well declining. Tamarack Valley. A Tamarack Valley well with water flooding going up. The rate has actually gone up from 200 barrels per day in its third month to like 500 barrels per day, 400 barrels per day in its sixth month. So when did Tamarack buy these things? This summer, when they realized what was happening here with the water flooding. So if the water flooding is going to extend the life of the well, extend the production, increase the expected ultimate recovery, maybe you overpay upfront and then you reap the rewards as this gets more and more understood and mainstream. So don't count out Brian Schmidt. He's not stupid. Yes, they overpaid, but they overpaid because they saw the 2023 and 2024 projections on what this asset is worth under a full water flooding sort of scheme. Charlie Lake, this is a one near Grand Prairie, Alberta, and very economic wells here. They're cheaper to drill. They don't need as aggressive of fracs, and they still produce similar to what a Montney well produces. Lower gas, but really, really high oil rates. You can also understand for PetroNinja when there's an infrastructure problem. So see how the well completely dies? That's not a natural trend in this sort of formation. So, okay, we know there's an infrastructure problem. Okay, when did this result come out for September? I had the data, call it October, 3rd to 4th week of October. Okay. That means that I can forecast every single Q3 production number on every single company. There is no excuse for getting caught off guard with what happened to Pipestone, with what happened to Kelt, with what happened to Obsidian. So if one has the time, you can actually front run Q3 results. You know exactly what the production number is going to be, where the production problems are, where the downtime happened. It could be July, it could be August, it could be September. So, not very happy with myself for missing the Obsidian sort of production miss because it should have been obvious in hindsight. But it happens. You can't track every single thing all the time. So you win some, you lose some. But if you are watching closely, the September results come out before most Q3 numbers are released. So this is literally an industry and a sector where you have informational edge. You can create your own informational edge. It's all public data. All this that I'm showing you right now is all public data. This is all freely available to every single person who wants to go and bother to look. So as things go on, as the cycle continues, this informational edge is going to be exploited by more and more people, and people who aren't doing it will end up maybe suffering the consequences. It might be nothing, it might be a little bit, but getting familiar with these things, I think, is important if you're wanting to hold a company, if you're wanting to play earnings with options and you want to do weekly options around earnings and whatnot. Like, how can you even do that if you don't have this data? Like, once you have it, it gives you such an edge as to where things are expected, at least on the production number anyways. Okay, so 2 more companies left. So Whitecap, Frobisher, really good, really, really good. I had mentioned on my Twitter feed the top Frobisher wells, the top Southeast Saskatchewan wells a couple of days ago. And this is the well that is 5 of 6 west of 2. So that section is bringing really good, that township, I should say, is bringing really good results. So Frobisher wells cost $900,000, and the well is making 500 barrels per day, 400 to 500 barrels per day. 6 to 7 months down the road, it's still making 300 barrels per day. So this well has produced 73,000 barrels in 7 months. It's paid out about 4 times, 4 to 5 times in 7 months. This is the power of conventional oil production, that these things can happen over a 12 to 18 month period. And if you don't realize what's happening, you're going to wake up one day and say, what happened here? The cash flow is absolutely insane of this company compared to when I looked at it a year and a half ago. Yes, because they drilled 20 of these wells that have paid out 5 times in 8 months. I'm not saying Whitecap has 20 of them, they only have 1. But as things go on, they've drilled more and more that pay out, and they continue to pay out over and over and over in a low decline environment. Whitecap Montney, the first well in the Montney that we have good results for, about 2,200 BOEs per day, 1,500 of gas and about 600, 700 of condensate. So pretty good. They paid a lot of money for this XTO acreage. We need to make sure they're drilling good wells. So a bit early yet, but watching closely, and we'll see how consistent they can be. If they can drill 20, 30, 40, 100 of these in the next couple of years, and they're all this good, there you go. You've basically proven out why they bought this land. And every hater can just keep quiet, because the play is so huge that they can do thousands of these over a 15, 20, 30 year sort of period. And there's not many land packages like this left. This was the last one of this size that anybody could have bought. They were competing with EOG, and there was a second company, I believe Marathon as well, that were competing for this acreage. So Whitecap beat those 2 companies who have way more money than Whitecap does. Whitecap's Cardium, the Wapiti Cardium, is looking really good. When I used to work there with Modern, we were drilling 150, 200 barrel per day wells. Some were 300 barrel per day. But to see 534 barrel per day wells coming online, something has changed. I pointed this out in the last PetroNinja wells update. Something has changed. They're either drilling deeper into the lower part of the Cardium, or they're using more aggressive fracs. Something has definitely changed. I don't know enough or care to dive deep into it right now because I don't have much exposure to the Wapiti Montney, or the Wapiti Cardium. But something that definitely one should try and figure out what's happened here. Could be a nice little sign of things to come for the Cardium. Whitecap's Glauconite, I mentioned Prairie Providence Glock. Whitecap is drilling some really good Glock wells as well. So once again, Whitecap and Crescent Point, some of the strongest technical engineering and geologic expertise out there. And it's worth its weight in gold when prices are high and you can drill these really, really good wells. Yeah, you can't buy this sort of expertise. There's not much left. People who can find these zones and find the best way to drill them, to complete them, to tie them in, etc. Yangera. So again, one that was mentioned in my Yangera presentation, their new Cardiums. Are they going to realize the mistake they're doing and fix it? On this well, yes, they made 500, 600 barrels per day. Second month is about 400 to 500-ish. Gas rate, pretty decent. Okay, they may have fixed the problem. No. This well is a complete fail. So again, they're making the same mistake. The wells are too closely spaced. This is good wells. The spacing on them, they're making 400, 500, 600, 700 barrels per day. They keep wanting to jam like 3 to 4 times the number of wells into the same section. And you get wells that are 1/10 as productive. Not sure what I can really say. I've been waiting for them to switch this type of drilling and well spacing, and they don't seem to care, or they don't seem to understand what the problem is. A couple other ones that are home runs on private companies: Aspen Leaf and Arc Financial Company in the Leduc Woodbend area is drilling these reef wells, and a conventional well making 2,000 barrels per day. Unheard of. This is new, latest technology, discovering a zone in a reef, sort of old play. It may not be a reef. Don't quote me on that. Producing this much oil, and they have multiple of these locations. Very interesting. And the Hammerhead Montney. So Hammerhead going public in January or February on the NASDAQ, HHRS, Hammerhead Resources, and really good Montney wells. Does this become the consolidator of the Montney once it goes public? They have the cash flow and the wells and the acreage to be that base asset that then goes and expands. So wouldn't count it out. Okay, right on. So that's the PetroNinja wells update. I see some questions here. So we'll take this. Yes, investors have to get over their allergy to capital expenditures. Yes, you have to realize the internal rates of return on these wells can be 500, 600, 700% at $90 oil. So if you are investing in these companies expecting 90 or even higher oil pricing, I'm not saying they go and blow their brains out on CapEx, but to nitpick every single dollar spent and say, this should have been a buyback, this should have been a dividend, I don't think that's the right strategy either. When companies have so much internal rates of return to generate out of their asset portfolios. Now, some companies are going to never do that. They just want to produce what they want to produce. Great. It fits that sort of investor. Other companies are going to drill and acquire and grow. There are many less of these types of companies than there were in 2012 or 2014. But these companies have their own niche investor sort of investor profile. So, expecting every company to do the same thing and go with the same exact capital plan, I think you're setting yourself up for disappointment. The companies are going to differentiate themselves from here on out. So just keep that in mind. And if the company doesn't suit you, that's totally fine. There's nothing wrong with that. There's other companies that may fit your investment mandate a little bit better. Okay, so IPCO has filed their phase 1 application. So, yeah, I personally do expect WCS diffs to normalize for 2 or 3 reasons. One is the TMX pipeline coming online gives us a secondary egress option, which is a significant enough volume now to matter. So that will help. The fact that the Russian barrels are going to drop off the market will help. And the fact that countries are building their own refineries is going to help. Mexico, Kuwait, Nigeria, there's 400, 500, 600,000 barrels per day refineries coming online. And they're taking this sour crude, sometimes heavy sour, sometimes medium sour, means there's less options for the US refineries to bring in. And that is a definite bonus for the WCS sour oil. The problem right now in WCS is not the heaviness of the grade. it's the sulfur content, because there's only so much desulfurization capacity, and it's expensive. It relies on natural gas. So if natural gas goes up, people don't want sour oil running through their refineries anyway, because it's more expensive. So as those things happen, it's not going to be overnight. It's going to take a couple of years. And in the meantime, WCS has really blown out because of the SPR. The SPR released a lot of sour oil that ended up getting stuck in Cushing or in the Gulf Coast. So the refineries there have a lot of optionality right now. And if they can underbid Canadian oil, like they have for the last decades, why wouldn't they? Why wouldn't they? It's simple economics. It's simple supply demand. Okay. Yes, I have had communication with Paul since the acquisition. Yes, multiple times. And you know, I'll be completely honest with you. I have given him my support to continue to make other acquisitions, as long as they don't dilute the shareholders in any sort of massive sense. So I think these acquisitions, which I'll discuss here in this rest of the presentation, I believe they're setting themselves up really good, and the company has executed on these acquisitions to generate immense value over a period of time as well. So, and yes, I agree. The companies need to do better at communicating their strategy. Make it crystal clear. What are you doing? What is your plan? What are you going to do? Now, they can't all tell you exactly what's going to happen, but make it clear. You are open to acquisitions. You are open to new drilling. You're not going to do a dividend. Make it clear so people don't get caught off guard. 100% agree with that. And yes, late 2024 for TMX is the date right now that I have for full service. Yeah. Yeah, I don't have the metrics on the acquisitions. The sale that Surge did in 2021, it was 2,800 barrels, I believe, per day for $100-something million. So it ended up being like 35 to 40,000 a flowing barrel, which is roughly, if you say, well, oil prices are much higher now than they were back then, is roughly about what they paid. And you know what? They got absolutely screwed on that, man. Like that Nipisi asset, water flood, and then the other Sparky stuff was so good. It was so good that it's just too bad. And Tamarack got a smoking deal on it. Yeah, not very happy with the way the banks did that, but that's the game we play. They set the rules, we play the game. Okay. Yeah. Okay, so I want to save these questions for after the Surge Energy, because I know people might be attending for that. So I'll get back to these questions at the end here. But I appreciate all the questions. So the Surge Energy technical review. So I have held Surge for a long time. I've built a very strong relationship with management and understanding of their mindset and understanding of the assets themselves. I love high original oil in place, lower decline conventional assets that have a lot of recovery factor to go and are just not really well understood. People are after these big, massive Duvernay, Montney, 1,000 barrels per day, 2,000 BOEs per day wells. Well, those wells are not the most economic way to do things in a higher oil price environment, nor is it in a lower oil price environment. They just happen to be good for high production growth. Like shale is not really even in an economic way to produce oil over a long, like 20 to 30 year period, which is really what oil companies are set up like. If you want the big growth and you want to sell it, okay, shale. If you want the long life cash flowing assets, they have to be oil sands or conventional. So anyway, I was really happy with these assets, and then they got into Southeast Saskatchewan last year, which I've been loving the Frobisher wells so far on every company. not just Surge, but Whitecap, Crescent Point, Vital Energy, some other small players, Innova Resources, etc. So been really keeping an eye there. And then the Sparky for its multilateral upside. When the multilat started getting good in the Clearwater, I said, Sparky, that's where it's going to apply. It's going to apply to the Manville group, not just Sparky, but the entire Manville group, Rex, Waseca, Lloydminster, Dinah, Cummings, all the formations, which I'll share here as the review sort of goes on. So I said, you know what, now that the acquisition is out, I think it's time to do a bit of a more technical dive into it and why these things make sense in a higher oil price environment, even an $80 oil price environment. And for my own doing some more due diligence on the new assets. The full disclosure upfront, this is not the full technical review that somebody would do. This is not the full technical review that the company has, obviously, or the expertise they have in-house. This is a 45 to 60 minute compressed session to get the point across, to get the story and the vision across as to what's happening here. So yeah, there's a ton of questions here. So I'm going to try and do the Surge ones as I go, and then leave these other ones for the end of the Surge session, if I may here. So yeah, so the question, let's start with this question. What is the advantage of 3 billion oil in place? Okay, right now you might say, what does it matter? You got 3 billion oil in place, you got 20 million. I mean, you're producing what you're producing. Yes. These oil cycles are not 2, 3, 5 year cycles. If you go back to 2000 and people say, oh, it was a 7-year bull cycle. No, it was a 14-year bull cycle. Look up the price of WTI on a 20-year graph and take the line from 2000 to 07 and just keep it going forward. You'll see it correlates to the line from 2010 to 2014, from 09 to 2014. That 08 spike and dip was a short-term dislocation, not because of oil, it was because of a general financial problem that occurred. So that cycle was a 14-year bull cycle where oil price went up 5x and sustained at 5x. We are entering that next cycle. When we enter these sorts of cycles, yeah, you can have shale, you can have massive production, you can have all this stuff. You have 6 years of drilling, you got 10 years of drilling, and all this. 2 points. The cycle may end up being a lot longer than 6 to 10 years, and it likely will end up being a lot longer than 6 to 10 years. So you want reserves, oil in the ground that is a 20, 30, 40-year sort of ground. The other thing with conventional assets is they don't really degrade. The acreage is relatively the same tier 1 or tier 2 across its acreage. When you have these frac wells and you have shale, it degrades and it declines. So you need to keep drilling to maintain that production, and you're drilling less and less productive acreage every time. So there's certain advantages to having more oil in the ground to begin with, and you can grow production and still have 10, 15 years of reserve. You can keep your production as is, and you don't need to acquire in that specific area. You don't need to go and do exploration drilling. You already have the reservoir mapped out. So Surge has about 5 or 6 assets. So we'll go through each one here, discuss why they're kind of important, and yeah, just provide a more sort of engineering side to it. So Surge Valhalla, northwest of Grand Prairie, and they have 2 zones here. They got the Doig and the Montney. The Montney being a relatively easier Montney, light oil Montney here, and the Doig being what they call a thick sand body. So I'll explain this as I go here. Here is this is one of the I think this is the Montney well. So comes out at over 1,000 barrels per day, 2 months, and it's got its decline to it. Relatively cheaper to drill than the big, massive Montney fracs. Gas rates looking really good. Here's the overall field. So you can see how since the 1995, it was on a decline, and then horizontal drilling came up. As you see, there's these old vertical wells, and then horizontal drilling came up, and the production increased, and it's relatively stayed where it is. Now, this has declined since about 2019, 2020. Why? Because it doesn't compete for capital. These things don't compete for capital under $70, under $80 oil. And they just get left. They get left, they keep declining, the operating cost goes up because you're producing less barrels and your fixed cost is the same, and you just end up with a declining asset. When oil prices go 80 plus, these things start competing for capital. And there's a huge runway here. Why? Because when oil prices went below $80, people started targeting the Montney and the Duvernay and other plays that make sense at a lower oil pricing. And these kinds of plays got forgotten. We haven't had above $80 oil with the horizontal drilling and fracking technology where it is today, or even close, for any sort of sustained period of time. 2010 to 14, yeah, people were doing a bit of horizontal drilling and fracking. Here's your example right here. But those weren't your monster long laterals. They did have the big sand fracs, the big proppant fracs. They did not have the geosteering technology that we do now. So this is almost a resurgence of these assets going forward. So definitely want to watch what are they going to do here. Are they going to drill more? I believe they have a couple of wells planned to sort of see how they respond to the latest technologies. And the reason the Doig sand is so interesting, if we go back here, right here, and right here, is because this is how the Doig sand is. It's thin, and then it thickens, and then it becomes this massive sand body, and then it gets compressed again. Okay. Now think about vertical wells. You hit one here, you hit one here, you may have hit this one as well, and then you hit one here, you hit one here. You missed these massive bodies that are blocked on the edges by propping mechanisms. So it's not one long reservoir. It has certain blocks in it, right here and right here and right here, that are blocking the flow from occurring. So when you drilled here, you took the pressure out of this part of the zone, but this opening is still virgin reservoir. It's brand new. The pressure has not been depleted. And that's exactly what this study on it said in 2014, that from 1990 to 2010, they produced 2.8 million barrels of oil using vertical drilling. So 15 years, they produced 2.8 million barrels. And the pressure had dropped by 75% in the reservoir. Okay. From 2010 to 2013, in just 3 years, Surge recovered another 1.5 million barrels and discovered areas of this virgin reservoir pressure, areas where the vertical wells had not reached. There is your example of new technology and using horizontal fracs. That was 2013. Now it's 2022. We have even better fracs. We have even better geosteering that can hit this exact pocket of thin Doig sand, get into the thicker one, go around the blockage, hit this one, go around the blockage, etc., etc. So a lot more low-hanging fruit that is brand new reservoir that hasn't been hit. And it's called an ATSB, anomalously thick sand body. Very well mapped out now, and they will be going back and doing a bunch of horizontal drills. They also have the Montney. So the Montney is below the Doig here, if I'm not mistaken. And it's a dual zone sort of reservoir. And once again, it doesn't compete for capital sub $80. It competes for capital above $80. And look at the wells, above 1,000 barrels per day, really, really strong wells. The gas itself is about 1,000 BOEs per day. And you can see how the overall surge production number can go up very fast if they start targeting a little bit of a development program in a field like this. Yes, I believe Rock Creek Freak is the expert geologist here, and I rely on his information a lot. And he's very extensively bullish on the ATSB bodies. So please, if you don't follow Rock Creek Freak and you're doing these technical sort of like reviews, trying to understand oil engineering and geology, you have to follow Rock Creek Freak on Twitter. Exceptional information and insight. Okay, so what are you getting with Valhalla? You're getting an asset that Surge paid $75 million for in 2010. And it was only making 720 barrels back then. Right now, it's making about 3,000 or no, 2,000 BOEs per day. So do some rough numbers. It's worth about, call it $200 million, what it's producing right now. Why do I mention this? Because these are the rates that companies go for in an extended bullish oil price environment. People pay hundreds of thousands of dollars per flowing BOE, even if it's 50-50 oil and gas. And companies under 1,000 barrels per day start getting a lot of bids. Why? Not because people are after production, because people are after OOIP, original oil in place, which they can target with new technologies, new fracs, new drilling. So a little bit of a digression, but people saying that the junior space in oil and gas is dead. Recency bias is an absolutely catastrophic thing. Recency bias will destroy your investment performance. It will destroy your mindset around investments. You have to go and look back. How do these cycles work? When does money flow into the cycles? What kind of companies get targeted in these cycles? Which companies trade at the highest dollar per flowing BOE? History doesn't repeat, but it rhymes. So there's a big informational edge you can get by figuring out where did your companies buy these assets from? Crescent Point, who did they buy? Baytex, who did they buy? Whitecap, which companies have they bought for how much? And what are those assets worth in a bullish $90, $100 stable oil price environment? Let's not let 2015 to 2019 skew your interpretations on where companies can trade, at what multiples, at what dollar per flowing BOE. Especially if you believe in an oil macro where oil demand keeps going up, these properties become more and more valuable over time, despite political headwinds, despite the ESG mandates. So now the other thing, when Surge bought this, whoever entered Surge at that time paid $5.25 per share. Since then, Surge has had an 8.5 to 1 split, reverse split. So effectively, the people who bought this asset paid over $40 a share at the time to get this asset. I'm buying the same asset for $10 a share. The difference into where valuations were and where valuations are is that staggering, and why I continually say the risk reward, from my opinion, this is all my opinion, the risk reward on these investments has been very de-risked based on the entry point that's still out there today. Here's a Monty well in the Valhalla. So this was actually a Doig well then, in that case. decent, 1,000 barrels per day. Its usual decline rate 3 years down the road, down to about 100 barrels per day. A typical Montney well, gas rates as well. So I'm not that intrigued by the Montney here. I'm intrigued more by the Doig, and then the Montney gives you that upside of like stable drilling inventory where you have a lot of openings, as you see here. There's a lot of open land here still to drill. Lots of inventory. Okay, so let's talk about now the carbonates. So the Mount Bastion acquisition. This was 2018, and 3 fields. This is in northern Alberta, and we see one of the fields here. So older vertical drilling, now the horizontal drilling comes in. When was this horizontal drilling done? Between 2010 and 2014, periods of high oil pricing. Now it just declines. It just declines. Well, it just declines. Surge did a couple of drills, 2016, 2018, Mount Bastion did a couple of drills, but not really a full field development with the synergies it brings. And you see how much of the acreage is still not targeted with horizontal drilling. So lots of open upside here in all 3 fields. And here is your well. So a nice little Slave Point reservoir well comes on at 200 to 300 barrels per day. In about 4 years, it's down to a stable 30 for the rest of its life. So what did they buy? They bought the Mount Bastion oil and gas assets. It was 5,500 BOEs per day, 2018. 98% liquids. Sounds familiar, doesn't it, with the recent Enerplus acquisition that they did? This group is not just going out and buying random things as to whatever's out there available. They target a certain kind of reservoir. And these kinds of reservoirs make a lot of money in a bullish structural outlook. You don't need $500 oil, you need $80+ oil. So they bought this within the Reef complex in the Beaver Hill Lake group with this decline rate, blah, blah, blah. And again, OOIP. Every single surge news release has this OOIP. They keep targeting these high original oil in place platforms, Reef platforms as well, with a low recovery factor. So you get more drilling inventory, you get enhanced oil recovery upside, and with the Reef complex, you get a CO2 injection upside, which was very expensive, very unknown a few years ago. Now it's starting to become the thing that people talk about as the next enhanced oil recovery sort of step change that's going to occur. A little tear shed here because they say the Mount Bastion assets are near the water-flooded light oil pools at Nipissing that the Banks and Tamarack stole from Surge. And have a reserve life of 12 and a half years, and only a portion of them are under water flood. This is the gravy for this team. This team is like a technical, conventional oil nerds. That's all they do, is look at these water flooding, low decline pools where they can go and find some geologic advantage and then produce them forever. So 3,500 of that came from the Son asset, which is up here, this one right here. And why is that important? Because it's a Reef asset. And a Reef asset has a lot of geologic advantages when oil prices are high. It has multiple layers of the Reef. It has side lagoons on it with oil. It has water flooding potential. It has CO2 flooding potential. It has NGL flooding potential. And it has infill drilling, and it has multilateral drilling potential. Hint, hint. So what does it look like? This is what a Reef looks like. So you have 5, 6, 7 Reef layers. It is literally, think about it like those reefs in the ocean off Australia and Hawaii and whatnot. The reef sits there, organic material, and then it gets squished by new sediment when the oceans move. So this entire reef of organisms is buried as is. It all becomes oil. So there's multiple layers, there's lower layers, there's lagoons on the edge, just like your typical coral reef. So what are they targeting here? They're targeting this Beaver Hill Lake formation. This map is not exactly of this area, but it sort of tells you there's a reef complex, and then there's a overtop oil complex on top of that, and then you have your shale. I believe that's a shale that blocks it, that oil from going any higher. This is an actual representation of this exact field. So you have your Beaver Hill Lake, you have your Slave Point Reef that goes down, as you see right here, it goes down, just like this reef, and then you have a shale on the end. What does a shale do? It blocks the oil from migrating anywhere else. So you have a natural trap that's not horizontal. It may be horizontal with the Musquash Shale. I think this is also shale here. And then the Otter Park Shale that blocks it on the edge. So you have this nice little juicy pools built in, which is kind of what you see here. One pool here, and one pool here. And just to explain CO2 flooding a bit more, because I think this is going to become very important, very, very important. CO2 flooding in reef sandstones and reef carbonates. So what happens? You have oil. So oil, you inject water, which pushes the oil, but you still have oil that's naturally stuck to the rock, like this. So when the CO2 comes in, it steals the oil off the rock because it goes into the oil and makes it bigger. And the oil becomes mobilized and then it starts flowing out. That's your CO2 flooding at its very basic. Now, in assets like this, especially, that have had water flooding done to them, this is what happens. You have a water flood that's pushing oil, but then water always finds its path of least resistance. Any river, any stream, any running water you've ever come upon, you get water picks its path, and then your fields start to decline because you're not pushing the oil anymore. You're just pushing water through this stream. What you do is you inject this layer of CO2. Water cannot go past CO2. CO2 cannot go past water for the most part. So you have this layer of water, you have a layer of CO2, which is like a brick wall that's being pushed, and it pushes this water and oil into the production well, which is on this side. So why am I so excited? Because reservoirs that are actively under water flood, that are going through this channeling, unstable flow regime, and they're conducive to CO2 flooding, have so much potential, so much oil in place that you will make so much money off these sorts of things. And I don't know if this SON asset has ever had any CO2 testing done on it, but having these sorts of assets in your portfolio as you pay back debt, as you then go become a dividend payer, as these assets become a lot more valuable, as oil prices rise, you want these assets in your portfolio as opposed to going and bidding on them and competing on them with other companies. And this is how it ends up. You have some trapped oil stuck against a rock. The CO2 comes in, it balloons up this oil because it goes into the oil. And now this big, a bigger oil molecule becomes mobile and starts getting pushed by the water. So oil bank, miscible zones, CO2, water, CO2, water. An extended bonus of this is when the CO2 is first injected, you get this oil bank that gets produced. You see how there's all this oil on the edges that's being left? When you inject CO2, all this oil moves as an army, as a front, and you get this huge rate up front of banked oil. You've literally put the oil in the bank, and now you're retrieving that to go and sell it and make money. So early stages yet, but keep an eye. If you're somebody who's really serious about learning what's happening in the latest technologies in oil and enhanced oil recovery, getting a really good understanding of CO2 reservoirs, I believe, from my opinion, is going to generate a lot of alpha. So I just keep that in mind, especially reef complexes that have these multi-layer potential. Okay, so this is what the carbonates is making, about 3,000 BOEs per day, and relatively flat with a bit of drilling. But still, the assets, since they bought them in 2018, have declined from about 5,500 barrels a day to 3,000. What does it tell you? They bought the asset and they never got to do what they wanted to do with the asset because they never had the money. These sorts of big schemes take time and money to implement. Nobody had money in 2018, 2019, 2020, 2021. So you're going to see this technical team, as time goes on, finally put some dollars into this asset and say, wow, like let's now show the world why we bought this thing to begin with in 2018. How many acres are in the carbonates? I don't know exactly how many acres this is, but let's see here. So this is about 30 sections, probably 40, probably 100 sections. So 64 to 80,000 acres, somewhere in there. So pretty significant amount. And they can be a consolidator of choice in this area. Once again, when I told Paul that I'm supportive of any further acquisitions, it's because I see bolt-on acquisitions in certain areas where they are the big operator, and for them to go and buy these things just makes sense to me. Not that they're going to use my advice and go buy stuff, but just when I talk, I like to present ideas, like legit ideas, not just, oh, you can do this, but, well, what do you think about this asset or this exact methodology or technology? Okay, so is the CO2 captured on the way out? Yes. So part of the CO2 gets stuck in the formation. It takes the place of the oil, and the rest of the CO2 is scrubbed from the oil and then re-injected. So none of it escapes in the atmosphere. None of it's dumped anywhere, because CO2 is a lot of money. CO2 is not cheap. Contrary to popular belief, CO2 costs a lot of money, and you don't want to just dump it or waste it. Okay, how low do you think Surge can get their decline rate? I think high teens should be possible, because they still have the Frobishers, they still have the Sparkies, so those are hard decline areas. So I would say if they can get it down to like 17, 18%, I'd be pretty happy. It's not going to happen by the end of next year, maybe mid 2024, something like that. So does Surge have the CO2 pipelines close by to do the flooding? So I get this question all the time when I mention CO2, and the answer is we don't know. We really don't know. Until somebody does the work and figures out, are there any big exhaust gas plants here where you can apply the technology of a company like Entropy, where you can use the carbon truck line. Alberta recently sanctioned like 13 or 15 projects to do with carbon sequestration. Are they near this? I have not gone that deep into it. And this technical presentation is also not every single thing that I know about these things, or that the company knows about these things. It's to get the idea rolling as to why they're targeting these reservoirs and what the upside is when they start competing for capital and when you have the money to go and do these projects. Surge has been a completely deaded company for many, many years. And then they were paying a dividend on top of that. So they didn't really have the money to go and do these projects because they do require a lot of money upfront and infrastructure for that matter. Okay, so that's that on the carbonates. I think, yeah. So, okay, there's a question here. Yes, right. Yeah, so Greg, thank you for this information. You had mentioned this to me before. So they don't have CO2 right now, top of their mind in Saskatchewan, because they need to do water flooding first, get the water flooding schemes going, get that really, really strong, and then do CO2 flooding. There's a lot of oil in these reservoirs, a lot of oil yet to be extracted, and water flooding, CO2 flooding, not only does it mitigate declines, it can increase production if you run your water flooding schemes properly for very little cost. So when you have large OOIP pools with low recovery factors, I'm buying. And you can probably see a lot of my portfolio revolves around buying things like that with very high net asset value, both that's already in the reserves and that's not in the reserves yet. So now the granddaddy of Surge, the Sparky. So we have the northern Sparky and then sort of the southern, more Macklin Provost Sparky. Here is your Wainwright area zoomed in. So right here, you can see how they're using the horizontal drilling, cookie cutter, very straightforward batch drilling process. And you have some older wells. And then you have the more southern Sparky, where you have the Provost area, which is horizontal fracs plus multilats. You have the multilats on the fringe here in Macklin, right here. And then you have your lower sort of other area, I'll just call it for now, where they're also using horizontal frac drilling. So how does the Sparky work? As I mentioned earlier, you have your Sparky member, you have your GP, you have a Rex, Lloydminster, Cummings, Dyna, McLaren, Colony. It's a stacked pay. All of this has oil. Different areas have different zones that are more productive. So companies might say, well, the Sparky here is thicker, it has more porosity, let's drill the Sparky. They might drill into the Dyna, they might drill into Lloyd. Companies are now drilling into the Rex because it's become economic using multilateral drilling. It was not economic earlier in certain places of the Rex. And you can see the same stacked pay in other places, Clearwater, the Blue Sky, Woolrich, Falher. This is your Baytex, Obsidian, Clearwater right here. This is your Martin Hills right here. And I hope I'm not wrong on that, because I'm still learning a lot of geology stuff. So it's kind of new to me a bit there. So, but yeah, it's a stacked pay. These are your old Sparky wells. They come on at 100 barrels per day. They decline to 30 in 3 years. These are your new Sparky plays, wells. Better fracs, better drilling. They can come on at 200 plus barrels per day, 250 in this case. Exactly what I said about the Viking and the Cardium is applicable to the Sparky. Surge is by far the dominant player in the Sparky by a long shot in terms of both land acreage and production. So let's look at some multilaterals that they're doing in Macklin. So the core Sparky is already very productive. Horizontal fracs, the wells pay out very fast. They pay out many times over their life. The fringe Sparky in the Macklin area, so we'll go right here. You see how it's sort of on the edge. Where is it? Yeah, this one here, right here. It's sort of on the edge. It was tier 3, tier 4, tier 5. They've gone in with multilats and made it a tier 1/tier 2. Pretty decent wells here. 150, 200 barrels per day, declining in 2 years to 40. This one didn't pan out as good, but you still turn tier 4 acreage into tier 2 acreage. So watch for multilaterals to get bigger in the Sparky as time goes on. They're not as game-changing as Clearwater, and there's not as many competitors as there are in Clearwater. So expect the technological advancements to take 3, 4, 5 times as long as they did in the Clearwater. But the learnings from the Clearwater can be applied to Sparky as well as you go. So here's a rough number I ran on these multilats at about $80 to $90 oil. They pay out 2 times in year 1, they pay out another time in year 2, and then they pay out 0.75 times in year 3, and so on and so forth. In a 10-year period, they will pay out 7, 8, 10 times. And that's at $80 to $90 oil. So very, very strong production as your base. Here's some more on the mineral rights. So you can see how the multilaterals can be applied to the fringe of these pools. Previously uneconomic, now there's all these side, like pool edges that could become economic using multilateral drilling. There's also open acreage that they said, well, this is tier 3, tier 4. Oh, why not go drill 2 or 3 multilats, pay $3 million, $3-4 million. You might prove out a brand new acreage. And guess who has the most technical expertise, who's drilled the most wells, and has the biggest land base in the Sparky? Right here, Surge Energy. So it's a mini cousin to the Clearwater. Why should I pay $100,000 a flowing barrel to be in the Clearwater when I can pay $40,000 to be in the Sparky and have all this open acreage with no competition and really, really good wells and lots of unexplored acreage yet to be had? So what have they done? They've had production go up 8x in the last 7 years. They have organically produced this oil. They've understood the acreage. They took something with 1,200 BOEs, they brought it up to almost 10,000 over a 7-year period of organic drilling, learning the play, applying new technologies. Sounds very familiar to these other plays they've bought, where people took the easy oil, they took the first 5% of oil out, and then they left it. They're like, we can just go drill other wells. Okay, great. We'll pick these up. We'll do enhanced oil recovery. We'll optimize your water flooding. We'll do infill drilling. We'll do multilateral drilling. We'll figure out the edges of the play and make tons of cash. Why bother drilling $10 million Montney Duvernay wells? There's a place for that in the portfolio, but these sorts of things, I sleep very well at night when I have these sorts of things anchoring the portfolio too. Again, my opinion, this is not investment advice. This is me sharing my mindset on why I buy these types of companies. Okay, here is the proof of what they're saying, that they increased production from this to this. Well, here's the proof. So the production earlier there's way too many lines here, in green, and how it's rising, and it's just this continuous rise over time. And they started doing some water injection and whatnot recently. Here's their well count. So you can see they're responsible for drilling a lot of the oil wells in the Sparky. So they have by far the best technical understanding of what's going on and how to produce this field. Now, this is a recent 4-well pad they did in Sparky. 211 barrels per day, right here, off the top well. This one is 200 plus. This one is 200 plus. I made this comment on the Twitter Spaces right after the deal was made, that there's a geologic edge here in the Sparky, and I'll talk about this a little bit later. Keep these numbers in mind, section 18 and section 13, and I will talk about these during the Enerplus acquisition section. So really good well up top. This bottom well, this 4th well, is 110 barrels, relatively weaker, still a really good surge horizontal frac, Sparky horizontal frac. But look what happened to this multilateral well right here. When they fracked this bottom horizontal, the multilateral production doubled right here, because some of the frac increased permeability into the multilat, some of the legs, and the production doubled, and it's sustained. How do we know the frac came in? Because the water production also doubled. So there's a natural permeability that's been created by this frac. Why am I sharing this? Because so far, the discussion has been we're going to produce either multilaterals or horizontal fracs. But Surge is at the cutting edge of finding the best way to produce Sparky. Can you maybe, let's say you drill 5 multilaterals first, produce a bunch of oil, and then you infill drill with Sparkies in the horizontal fracs. You get the frac production, and you push oil into the multilaterals. It's going to take some time for this technology to advance, for field development to advance. But the fact that you have a mini cousin to the Clearwater, and you have one company that knows this like the back of their hand, and everybody else has no idea because they're just not active in the Sparky. Now you see why I'm so bullish on multilateral technology in the Sparky. Yeah, so they are doing a bunch of different things. You know, just because I say that this thing can do CO2 doesn't mean they stop doing water flooding somewhere else. Like they're doing many things: water flooding, NGL flooding. You can sometimes inject gas. You can inject CO2. So the idea is that large OOIP reservoirs with low recovery factors have multiple ways to produce the oil: initial recovery, water flooding, gas flooding, CO2 flooding, infill drilling, multilats. There's multiple things you can do. Whereas with a shale play, high decline, you can't water flood it, you can't CO2 flood, infill drills are not economic, the fringe acreage is not economic. So you see the point I'm trying to make. Like there's certain things that multilateral or conventional high OOIP pools have in place, which is why I answered that question at the start. What does 3 billion barrels of OOIP do? It gives you the optionality to produce this oil over a longer period of time. But when oil prices go higher, you got so many value levers here that you can extract value from and accelerate development. So, okay, I don't want to get caught off guard here. So here's your frac well, here's your multilateral. This is the only example I have of them doing this. This multilat is not even their multilat. They bought this from Westlake. So why would they go and buy one well? Because there's a science experiment going on here, and they wanted to see what would happen. They probably knew that their frac on this well was going to migrate oil into the multilateral. So they went off and they bought this one well. Something to think about. Like, we can figure these things out without management telling us. They're never going to tell you these sorts of things. But if you can figure them out and invest your dollars accordingly, there's a benefit that flows over time to understanding engineering and geology. Okay, that's that on the Sparky. Don't forget section 13 and section 18. I will discuss them later. Southeast Saskatchewan, 2 major acquisitions: Astra Oil, 4,100 BOEs, and Far Sky Energy, 1,500 BOEs. This is what they bought. Some in Manitoba, some in Saskatchewan. You have the Midale crop. So below this is the Midale. The Frobisher subcrop. Below this is the Frobisher, and then the Alida beds as well. The Alida is not all that economic. The Frobishers are really good, and the Midales are interesting because they have multilateral upside that nobody's drilled yet, and I can see the gears turning in certain people. They keep saying Midale, Bakken, multilaterals, or more aggressive fracs. Okay, so let's see what comes of that. But so 2 deals they made, paid it largely with stock. People were not happy. The entire thing got diluted, almost doubled. So we had 40 million shares. It went to 80 million shares, and people were not happy with the acquisitions because of the dilution. And Surge proceeded to have one of the best performances in its peer group in 2022. Once the deals closed and once the narrative sort of played out over time. So what happened? They bought these, they paid a bunch of money, and they drilled really good wells. They targeted 2 companies that were stuck, where private equity had been stuck for 7, 8, 9 years. They had really good production. They had really good reserves. They had really good drilling inventory. But private equity wanted out. They said, sell it, just sell it. We don't care. We want out, just sell it. And Surge went in, scooped them up after they had delineated a lot of the acreage. And now look at the wells they're drilling. It is not even close. I posted this on my Twitter 3 days ago. It is not even close. The monthly liquids rate that's coming out of these 2 Surge wells and this one right here, 474. None of the companies are even close. Here is the Whitecap well I discussed in the PetroNinja wells update. So a really, really good well. Look where it is. It's right next to these Surge wells. So Surge saw what was happening. The wells that were coming out, they got some logging data, some coring data, and they beat these guys with a punch. They went and bought the best Frobisher acreage from these private companies that had done the delineation and the de-risking over a 8 to 9 year period. Simple as that. And now they get the benefits of that. These wells pay out in 30 to 45 days. That's how good they are. $900,000. I would say some of them pay out in less than 30 days. These 2 specifically, less than 30 days, you get your money back. In 90 days, you get your money back 2.5 times. In a year, you're probably getting your money back 5, 6, 7, 8 times in certain cases. So absolutely exceptional, just phenomenal. And they've got hundreds of these locations, not as prolific, but somewhere in the general vicinity of being, top 15 wells every single month. Cost efficient, 900,000 a well. Very quick turnaround. I showed you the Montney well earlier. Spudded January 30th. It came online in July. These wells spud to production in under 2 weeks. And I don't want people to construe this as me bashing the Montney. The Montney and the Duvernay and the shales have their own little specialties. But this is more focused on Surge and why what they're doing makes a lot of sense. And there's really nobody else with this much value levers in all their different packages that has not been properly exploited or capitalized because they just haven't had the money yet to do these things. And the assets they are capitalizing are showing really good results. I showed you the Sparky, and now I'm showing you the Southeast Saskatchewan. These wells are more than double as good as any well out there. Here's another one that didn't pan out, so made about 70, 80, 100 barrels per day. Not as good. It's still going to be a 4 to 6 month payout, and if prices rise, even faster. And it costs $900,000. It's literally like so cheap to drill these. And there's a reason I was looking to buy these Frobisher lands earlier this year because they're just so cheap to drill. They pay out so fast, and even the ones you miss on end up paying out in 4 to 6 months. And you have the off chance of hitting these gangbusters. Here's an older Frobisher, so 300-400 barrels per day, but only for a month, and then it dropped off and sustaining about 30 barrels per day for the rest of its life. 20 to 30 barrels per day, great. I can just stay there. Okay. Yeah, thanks, Kirk. For sure, yes, that's the most accurate terminology to use. Okay, what would be the break-even price? So I'm not even going to try and answer that question because I don't know what break-even price means anymore. It just misconstrued and changed so many ways. But if you're worried about break-even price on any of these companies, like is the break-even 30 or 40, and you think oil prices are going there, I don't think I would invest in any oil company because they're all going to go down. The shares are going to get trashed if oil goes 40 bucks. Even if they're making money and their break-even is 35 and they're making money at $40 a barrel, the shares are still going to get absolutely railed. So I've stopped looking at break-even pricing. To me, it's not that important. The net back is a bit more important going forward. So there's a question here. Since companies drill their best stuff first, you would have to assume it's as good as it will get. Yes. So there's a caveat to that. Companies drill their best stuff first when they know what the best stuff is. So if you're going drilling and you know your entire field, you have it mapped out, you can go and drill the best stuff first, 100%. When you don't know the field, when you're going and buying relatively undelineated acreage, there's some step out wells, there's some new technologies, there's some new fracking happening. You might find that as you go on, you're going to find nice pools, nice juicy oil pools. You're going to find a certain technology works really good, better than even what you thought. So it doesn't quite apply in the Sparky and Southeast Saskatchewan, but you're right. I would be surprised to see wells go more than 600 barrels in the Frobisher. They just don't exist in a large enough quantity as maybe you would think. But you know, if there's one team to bet on who's been showing results, here it is. So yes, so the companies will survive if oil hits $40 for 3 months, yes. But they're still going to get smashed. They'll be down 80%, 70%. If oil really hits 40 bucks for 3 months, yeah. If it's a short-term dip, I think if the companies can sustain the share price laddering. But yeah, it's completely unlikely, right? Like it's not even in the expected value possibility of things that can happen. But anyway, I'll take that one. I'll humor you. So here's Southeast Saskatchewan surge. So you can see it's a growing field. When you have growing fields, there's a possibility that the wells get better and better as we're kind of seeing what's happening over the last 2 to 3 year period. The Frobisher is pools. It's small pools right here. Pool. It's a pool. And it requires a lot of geologic knowledge. It requires a lot of technical expertise, looking at coring and logging and charts. So what did Surge do? They went and bought companies that have already done this for 8 years. These people have been putting their hours and hours and late nights and money and efforts into finding these pools, exactly figuring out where the pool is, and then they bought them as soon as the oil price turned. 2 companies, Astra and Farsky, relatively comparing. This is the Bakken right here. You see how just cookie cutter, like you don't need to do any geologic work. You just go and start drilling these side to side in a cookie cutter fashion, and the whole thing is a Bakken pad, whereas these things are small little pools. This is 6 miles by 6 miles is this one of these boxes, just to put things into perspective. Same thing here. So you can't even really see the lines, but 6 miles by 6 miles right here. Okay. So before I continue further, I will say for anyone on Twitter that would like to join for the Zoom, whitetundra.ca. If you scroll to the bottom under events, you can join us for the latter part of the Zoom here, and for the Q&A session if you would like. If not, the Twitter space, I believe, is running. Hopefully there's no issues so far. So 1 second, I'm going to grab a Kleenex. we will restart the recording there, and it might take a little bit longer to upload this, just to merge the two files there, but it will be done. Where was I? So the bucket is more of a cookie cutter sort of formation. The Frobisher, you really need the pools up front, and the company has bought two companies that have the pools up front. So that's that. Southeast Saskatchewan is about 5,500 BOEs per day, 6,000. The Sparky is doing 9,500 pre-acquisition of the Enerplus asset, and then we have the do that, and then you have a Shaunavon asset, about 1,000 barrels per day, old school, nothing really major going on here. It just does and produces. These are the wells, about 100 barrels per day here. Last drilled in 2019. We have the a 2018 drill, but nothing crazy here. It's just another cookie cutter sort of extra value lever. It probably is not going to compete for capital, just given where it is in its cycle. But you know, as time goes on, this could be sold. It could be developed going forward. So a nice little extra pool, about 1,000 BOEs per day. This is how it's set up. So you have the producing wells and you have the injecting wells. So the arrow ones are your injectors, the black lines are the producers. Here we see what's happened with the wells. So the wells start off as producers, and about 2 to 3 years into their life, they get converted into injectors. Depending on the way the water flooding scheme is, I really like this way of water flooding, where you have one injector and then a producer and then injector, because you push oil from both sides into the producer. So having that sort of method, I believe they call it a tuning fork method, works really quite well. And here's another well, where am I here? That just producing, and then it had water flooding support put in, and it arrested the decline. So here's a non-water flooding well declining the whole way through. Here is a water flooded well, so it declines, and then it gets this pressure support and oil being pushed into it from a nearby injector like this one. And this is how it works. So you have a beam pumping unit, which is your producing well. You have water injector, and yeah, the one thing that's really hard to get across, maybe, you need to think of these wells as a 3D well. It's not just a 2D well where water is getting pushed. The water can go 360 degrees. So what they'll do is they'll have a producing well, have an injector closer to me, have an injector further, and on both sides of the well, that just pushes the water into the oil. And many water flooding schemes across Alberta are run wrong. They are run because people are not paying attention. They are run, nobody had the money to put into it. They are run such that the engineers and geologists are stuck, or not stuck, are putting their time working on bigger assets. So stuff like this just gets sort of left behind and ignored. Hint, hint, what happened to Enerplus? So if you can optimize your water flooding schemes, you can have different injection rates, different injection points. You convert different wells into producers, into injectors. You can get a lot of extra oil that's stuck. So here's an example. Look at this oil right here, this bank sitting here. You have an oil bank here. You have an oil bank here. If the person looking after this asset doesn't know where the oil is, based on reservoir simulation, reservoir modeling, that oil can sit there forever because the water has found an easier path. It flows up here, goes here, and here, and here. This bank is just sitting here. So what do? Well, there's many things you can do. You can drill another injector here. You can maybe, let's say, stop this injector, and maybe you stop the producer, and you then push this water, it has to go into this area because this area is already pressured up with water. So there's plenty of things you can do, but they need to be done. And the right amount of hours and effort need to go into it, which Enerplus obviously didn't have and didn't care about. Very important. Here's your vertical injection well. So vertical injector pushes this oil. You see how the water is heavier, so it goes down. And then you inject something else, which floats. So you inject like a NGL, you inject a propane, you inject a gas, which can then take out this part of the oil, which is sort of getting bypassed as the injector does its thing. So optimization is going to be a big way to increase production, to mitigate declines, to add production to old declining reservoirs that you buy from companies that don't care about them. Here is your Shaunavon field. So you can kind of see it was making 3,500 barrels in 2017, and it's actually down to about 1,000 barrels per day here. So what happened? Well, it didn't compete for capital. So they barely drilled. There's some 18 drills, there's some kind of 2019 drills, but not how much money could be put in here. So the productive capacity of this reservoir is much, much higher. Once they get to it, once they find the money for it, a lot of optimization here for something that's only about 5% or less of their total production. Great. Here's an example from Crescent Point in the Shaunavon area and what they're doing. So the well, not that great of a well, but they put water injection on it, and it went from making 4 or 5 barrels per day to about 150 barrels per day. And it's still making 30 to 40 barrels per day, about 8 to 9 years down the road. When you put the time in, these are the sort of results you can get, because there's many oil banks just sitting there over time. They just start sitting there, they accumulate, nobody does anything with it, and then you capitalize it with the right company. So where do I end up after all this? Is this slide right here. The conventional, low decline, high permeability reservoirs that are cheap to drill and have a high original oil in place. This company has 5 of them. And why I'm so supportive of everything they do, not only because they make good deals, but because they technically have proven to me that the previous deals they've made have ended up making sense over a long enough time frame if you're willing to hold the company for that. And I've been in this company for almost 18 months now, and I think you will continue to see this as one of my larger holdings, probably a year down the road, 2 years down the road, because there's so much hidden value that's not unlocked yet. And when you have companies like this with huge tax pools for 2, 3, 4 years, that's what I target. That's what my portfolio, my top 5 represent. The idea and the story that I really appeals to me going into a structurally bullish oil environment. So I think there's some questions I missed probably here. Oh, I lost all the chat. No way. Okay. So yeah. So there is a bottleneck. Yes, there is some supply chain issues, but they're not as big on the EOR and servicing side as they are on the new drilling side. So these projects can go through without significant delays or problems. There is still some backlog on like well site engines, on certain kinds of service equipment, on certain kinds of polymers and chemicals, but it can all be dealt with, as opposed to drilling, where if you don't have the rig, you don't have the rig, no matter what. So let's talk about the Enerplus acquisition. So 200 million net, about 68 million annual cash flow at $80 oil. So pays back 3 times in 3 years. Pays back 1 time in 3 years. 99% oil, great. And the 2P PDP reserve is 7 years. The 2P reserve is 10 years. And obviously, as the price goes up, WTI price goes up, the net back goes up correspondingly. So 3 assets: Southeast Sask, 100% oil, 11% decline. 2 Sparky assets: Giltedge, Cadogan, 1900 BOEs per day, about a 12% decline combined, 12 to 13% decline combined. Okay, so they're lowering the decline rate. They're getting more water floods. They're getting oilier. Fantastic. More than half of which is light oil, and it's already in Southeast Saskatchewan, so it goes directly into the Enbridge system, going towards Chicago, or on the Bakken lines possibly as well. So the quick math as to how a water flood works: you have, they're saying 10 years of 2P reserve, 15 million barrels of 2P reserve, proved plus probable. 15 million barrels on a 400 million barrel OOIP is about a 4% recovery. So what the reserve evaluators are saying is you have 4 years of reserve that you can produce no matter what you do. No matter what you do, you can produce 4 years of reserves. Doesn't seem realistic because water floods go up to 24, 25, 28% recovery factors. It's currently only at a 14% recovery factor. And then you put polymer, and then you put CO2 flooding, and then you put infill drilling. Your recovery factor could go up to 35, 40% in some cases, and it's not in the reserves. So people say they bought a 10-year asset. No, they got 10 years of current reserves. As time goes on, that recovery factor just keeps getting proven out. The first time they inject polymer, you get extra more reserves. The first time you inject CO2, you get extra more reserves. They're just not in the calculation today. So when we say just the water flooding can get it from a 14% recovery factor to 24%, that's 10% of 400 million barrels, 40 million barrels. That now ends up being a 27-year reserve of just water flooding. The other technologies come on top of that. So whenever there's a transaction for water flood, your reserve life index number is wrong. It only calculates current reserves. You can't just say, oh, well, this water flood over here made 40% recovery factor, so we should get credit for it. Nope, you will get laughed out of the building if you said something like that. You have to prove that your field is producing at the same rate a year from now, and then 2 years from now, and then 3 years from now, and then 4 years from now. And you get 1 year of extra reserves every time. So this 10-year reserve in 10 years will still be a 10-year reserve. It's just the way water floods work. And I can provide, in fact, I will provide a lot of examples in the water flooding seminar on like examples where water floods have done well, and then what the CO2 flood added, and then what the polymer flood added, yada, yada. So 3 assets, Enerplus Cadogan, we'll start with this 450 BOEs per day, 99% medium oil, 10% decline rate. This is in the Lloydminster formation. So not in the Sparky, but in the Lloydminster, remember. Nice, cool. Vertical drilling, a little bit of horizontals now, new ones coming in. Here is your production of the new wells. So on the new horizontals, again, you see this tuning fork method, 1 producer, 1 injector, 1 producer, 1 injector. The new wells, very low decline rate, very, very low decline. So about call it, from a stable rate, you got about a 50% decline in 4 years. Very nice. And the entire pool itself, extremely stable. Since the 1990s, early 1990s, it's literally produced at the same rate. Green is oil right here. And that's what happens. You get 10 years of reserves. Every year you produce 1 year of reserves, you get 1 extra year of reserve. It just like this continual thing until you actually start declining. So nice little water flood in the Lloydminster pool with a bonus. Remember section 13 and section 18? This is where those monster Sparky wells were that Surge did really well on. Guess which rights they got as they bought this Lloydminster pool? All of them. They got all the rights to all these members. So what are they going to do? They're going to take these Sparky wells from here and just apply them underneath these Lloydminster wells. So you just opened up another, call it 20 to 30 top tier 1 drilling Sparky locations, which Enerplus just didn't care about. They're like, we don't care, man. We just want to sell this thing and move on. 30 of those locations, each location has probably an NPV of $3, $4, $5 million. There's $100 million of NPV and AV at $80 oil right there. And doesn't include any drilling into any other zones. It doesn't include any multilateral upside or the water flooding upside, like doing more horizontal drilling here, increasing the production. It doesn't include any of that. That's $100 million right there. Okay, Gilt Edge, about 1,400 barrels per day. Very similar field. Again, there's so much horizontal drilling to be done here. There's all these short little stubby horizontals. We need these long horizontals with the one producer, one injector, one producer, one injector. It's so cookie cutter. If you put the time into it, you identify the pool boundaries, and this thing just breaks in cash all the time, no matter if oil price is low or high. And if oil price is high, you make a ton of cash because it's low decline. So a lot of your cash flow becomes free cash flow. Here's the drills. They were drilled in late 2020, have not declined. Production has gone up on this well. In 2 years, production has gone up as opposed to going down. Here's one that suffered because the oil bank was sort of moved or something changed in the water flooding. This well completely died off. It went from 70 barrels to 6 in 3 years. So what would a production engineer do? They would say, look, what happened to this well? Where is the oil gone? Did it go here? Okay, great. Well, how can we now bring the production of this back up? So this well, for example, could be, just throwing this out there, I don't know this exactly. This well could be this edge well right here. So what do? You now go and drill an injector on the side here, and you start pushing oil into it again. So lots of things can be done. Lots and lots of things can be done. You just need the technical team to put in the hours into doing it as it should be done. This is the entire Gilt Edge field, flat, absolutely flat. Since 1995, it's been producing this 1,400 barrels per day every single year. We have 27 years of production at this rate, and you're saying there's only 10 left? If there was only 10 left, it would have started declining already. And look at the map. There is so many drilling locations still to go. The pool is still being extended. So maybe there's more here, more on the edges here. Lots going on here. Water injection. Don't forget, water flooding is a big project. For every 1,400 barrels they produce, they're producing 63,000 barrels of water and injecting 63,000 barrels of water. So think about it. You're just skimming one drop of oil for every 30 drops of water you're putting in. And it just skims, it skims all day long. And now when you drill a new well, you now access a new part of the reservoir that's more oily. That Enerplus just didn't care about. They just wanted to get out of Canada. So, okay, what else is going on in Gilt Edge? Enerplus did a polymer flood in 2011. So they did a polymer flood trial right here, and they have the recovery factor and whatnot, and the reserves that they were getting earlier were already way higher than what Surge is getting or what Enerplus has right now. Why? Because they aren't putting the right money into it. When you stop capitalizing things, your reserves could actually drop because your production is dropping. You're not actively managing the property. So they already had the reserves. The reserves got taken out. Now the reserves are going to go back in. Plus, they already have data from a polymer enhanced oil recovery project. Low decline, high netback. The polymer started in 2011. And what happened? So they injected polymer for 6 months. They were going to do it for 4 years. What happened 4 years from 2011? Everything crashed. Oil prices crashed. Nobody had money. They didn't want to do anything. The intent was to be at a full field polymer flood by 2017. Hasn't happened. So now that prices are rising again, even more benefit, not just water flooding, you have the polymer flooding results, and the polymer was only done in this area. So the entire rest of the pool can benefit from the results and from more trials. And just the polymer flood adds 10% incremental recovery factor. Just the polymer flood, let alone the water flood. So add another 10% to whatever recovery factor I gave you. I said 24% with water flood, add another 10%, 34 with polymer. Then you do more infill drilling, you do other types of NGL injection, other things down the road. But just bringing it to 34% gives you 50 years of reserves, 54 years of reserves. So there's no point even thinking about the other stuff at this time. And so, yeah, so that's gilt edge. Saskatchewan, 1,900 barrels per day. So this is in the Ratcliffe Formation. Current reserves are booked to 26%. This was back in 2012. So they already had reserves to 26%. Right now, these fields are on average 14% recovery factor when you take all three combined. There's also some Bakken rights. The Bakken results have been disappointing. Very close to where the Crescent Point multilateral Bakkens worked in a fringe area. Again, thinking 2 steps ahead. It costs very cheap to go drill a Bakken test well. They already have the rights. See what comes out. It doesn't have to be today. It can be 6 months. It could be in a year. It could be in 18 months. But having those functionalities, those value levers, very important. Okay, so yeah, so the share dilution to purchase these ones is going to be, I think, end up being about 10%, 10 to 14%, somewhere in there, share-wise, because there's the broker private placement and there's shares being issued out of Treasury. So when you take those two combined, I think it's about somewhere between 10 and 14% dilution. And production goes up about 20%-ish. Cash flow, I think about 14 to 20%, somewhere in there. Lower decline assets, obviously, so the cash flow is more going towards free cash flow than compared to other assets that they currently have. Gilted is northeast of Wainwright, yes, correct, yeah. Yeah, I don't know how to pin the chat either right now, unfortunately, but we're pretty close to the end here, so I'll just continue on. So in the Ratcliffe unit, this is what Enerplus said in 2011. This field is producing at this level, you know, whatever. Let's do some optimization. Okay. So what did they do? They did some more horizontal drilling. As you see, now there's some more horizontal drills in here in this unit as well. At the time, they only had a few, and they started getting lower royalties with the new wells. And the new horizontals had a way lower water cut. So just like I described on the Gilt Edge and Cadogan, when you drill horizontals in new parts of the reservoir, you hit the oil bank and you get better water cuts on these new wells. So they expected this to get to about call it 2,200 barrels per day based on their simulations. This thing actually got to about almost 4,000 barrels per day in 2013. So it responded way better to these new technologies. And then prices collapsed in 2014. So it's just been declining ever since. Nobody went and decided, oh, we should do horizontal drilling here, and we should do some other injection work here. It just got left to produce in a blowdown scenario. So now we come back, and an operator that can capitalize it has the money again and has the asset again to do some work on it. And it has Bakken rights as well, which is a very low potential of success, but Crescent Point just did it. So it's a new thing that could be interesting. And it says they tried drilling Bakken here already. So there is a fringe Bakken zone already here. So where do we end up here? We take Gilt Hedge, OOIP, we have Cadogan, we have Frida Lake, which is the Southeast Sask assets. They had figured at the year end of 2012 that there's 300 million barrels of OOIP in these assets. Now we know it's 400 million. So not only is the recovery factor potential going up, your OOIP is going up as the pools get more delineated. Okay, what about the reserves? The 2P reserve right now we're getting is 15 million barrels. At the time, so you take this, and you take this. We had about 25 million barrels of reserves. Okay, in the meantime, now some has been produced, yes, but there's a contingent. There's about 30 million barrels of contingent that was going to get given over time that still hasn't been given because it's still contingent. So the reserves evaluators already knew what was going to happen with the contingent resource, with what they're saying, okay, maybe, maybe not, but we'll throw it in there. So over time, the value of these OOIP reservoirs gets unlocked as you capitalize them, as oil prices get higher, as new technologies hit it. And in the meantime, it continues to produce at no decline for the next 10 years, 10, 15, 20 years. And that's why the acquisition like this, if you believe that we're in another 7, 10, 14-year oil cycle where we don't need oil price to 5x, as it did from 2000 to 2014. We just need oil price to stay above $80. And all signs are pointing, if you ignore today and tomorrow and next week, if you look into 2023, 2024, 2025, with the macro outlook that I have anyways, is that we're not going to see extended periods of sub-$100 oil ever again. And in those sorts of climates, with the upside risk on oil past that, these sorts of assets, buying them today, you're not going to get these opportunities in a year. You're not going to get the opportunities to buy Southeast Sask that Surge did last year, this year, because now people know about the Frobisher, people know what's happening, the new technologies, the new pools. The same way these water flooding assets will start becoming expensive into 2023, 2024, 2025, and a lot of potential. There's a lot of money being thrown around for doing EOR and CO2 flooding and CO2 infrastructure, CO2 sequestration, et cetera, et cetera. So an evolving story, I'd rather be in an evolving story that has these things in their pocket and in their shoe and this extra value lever here and that, and the uncapitalized assets from Mount Bastion and the Valhalla Doig and the Shaunavon, which has nobody's even looked at that, even within Surge, for years. And then you got the Sparky base and the Southeast Sask base with these monster wells. And you got 3 years of tax pool on top of that. And a management team that's executed. Very important. The management team has not just bought junk. They bought assets that have they put their technical expertise into and proven results, including the latest Southeast Saskatchewan asset with those three to five really, really good wells. So I'll end it there. I just want to caveat again, this is not the entire technical review that one would do on something like this, but I think another 7-hour presentation, I would start scaring people away. So I think this is a perfect sort of intro. And if there's any questions on it, I'm happy to run a more detailed technical presentation with some reservoir models, with some logging, and maybe some core data and everything else. But in the new year, I think I want to slowly see how these go. And I know there's going to be people interested in learning more about the oil industry. So I will keep that as a future sort of session possibility. And it doesn't have to be Surge. It could be, we could pick Baytex. We could pick, well, maybe not Baytex, but maybe we could pick Journey. We could pick Cardinal. Something in the 15 to 20,000 barrel range that has 4 or 5 assets. We pick that, and then we just go and sort of do this sort of deep dive on it going forward. Okay, so is this the best acquisition in Paul's history? I don't know his history that well. He's made a lot of deals. I think this is a good one. I like the acquisition of FarSky actually really well. They got a lot of good inventory there. Astra was decent, but it was a bigger package, so not as much Frobisher upside as they did with FarSky. I still like the Mount Bastion acquisition. I think those reef plays and carbonates are not getting proper valuation. I think the original oil in place there is much bigger. People just haven't explored these reefs as much as they should have, or did have the technology to explore them. And those Mount Bastion assets are like way up there in the swamp, like north of the Clearwater. So there's some problems with the location access, the year-round capability, the infrastructure. So all these things don't really compete for capital until the time comes. And when it does, you get really nice, juicy production, reserves, cash flow increases as they capitalize these assets. Okay, what kind of reserve value does Surge have in total? So right now it's about $17 a share at a $73 WTI price deck, excluding the Enerplus acquisitions and at whatever they currently have. I think I've made the case that it should be much, much higher, and that's at $73 oil. That's a 2P reserve, I should say. You start running those things at $100+ oil, things get quite interesting. Things get very, very interesting, especially as it capitalize assets and those barrels start going into reserve values, 1P, 2P, PDP, PDNP, and then the probable as well. So no insider buying since February. Yeah, I don't really have any insight into that. I would love to see them buying more, obviously, but I believe they have pretty decent chunks in there, and not all the shares are being reflected because the management has a lot of family and friends that are also involved in this play. It's still not any meaningful number per se on insider like buying or anything. So yeah, I guess I'll just put it this way: it doesn't really bother me as much as I would like to see it. It doesn't really bother me because they've had their money in this for a while, and I think it makes sense to get some dividends back to grow the company first, and then they can look at doing some more insider buying. Like their entire livelihood is already tied to one company. That being said, Paul was a board member, I believe, maybe the chairman of Rising Star Resources, which Tourmaline bought. So I'm not sure how much money he got from that, but he might have got a nice little chunk of change. So might be looking to allocate that going forward. I believe Surge has 1 billion or so, maybe 1.3 billion of tax pool. The way I calculated it, they have 3 years from June 30th, 2022 at that sort of $80 to $100 oil price. They have 3 years. And that's sort of what I want going forward. Yeah, no, thank you so much for sure. So let me see here. So I don't want to crash this. Hopefully it doesn't crash when I open this Slido thing. That's really bizarre. Like I bought this new laptop and it's got more technical problems. Like I basically maxed this thing out for hosting Zooms and streaming video and whatnot. And this thing's crashing more than the 4-year-old laptop I used to use. Maybe the video quality may be too high or something. I got it set up as. Yeah, so I'm not sure what Paul said on BNN. I never listened to it, but I assume you're referring to his thing after Q3, and I don't really know what to say because I think the deal was done in a very short period of time. As soon as Enerplus closed the Journey acquisition, it's like that was the catalyst to Surge doing this deal, and maybe they weren't really prepared for it in a way. Because it is bizarre. You go release Q3, you go on BNN, talk about it, and then you do a $200 million acquisition the next day, right? Like, why would somebody plan it that way? So I think it just happened. They had to pull the trigger quick, and that's what they ended up deciding is, look, we want these assets, so we are going to do it. They must have spent months on the due diligence on this already because these Enerplus assets have been on sale for months. Previously, and sometimes a guy just gets caught, right? Like there's a deal may happen, but you don't know when or if it will happen, and then you get invited to BNN, and like, what are you going to say? Are you going to say we have an acquisition pending? No, you can't say that. People will undercut you. People may sell the shares, and then the acquisition doesn't end up happening, right? It's just too bad it had to be that way, and I'm not going to excuse him for it because I still think it was a mistake the way that was handled. But yeah, I guess it's not really up to me. I'm investing in this based on management executing on the technical portion of what they said they would, not exactly for being the most how should I say, the most transparent or the most obvious as to what they're saying. Like, I had to figure all this stuff out on my own. They never told me about the Sparky upside or the Frobishers or the Mount Bastion reefs or the Doig. Like this, they're not going to tell you these things. It's a very technically focused thing, and oil companies typically have not been very transparent to begin with. They don't really see value in telling people these things because people don't really care, for the most part. It's only recently that there's a very high retail investor presence in some of these companies. Yeah. Is there a rig in Mount Bastion? There may be. I don't know where their active rigs are right now. I've been just caught up in so many things right now. It's been sort of a busy time, so I am losing some things that I'd like to keep track of, but that's just the way it goes. So I don't know exactly where the rigs are right now. I will say, based on the production that I'm seeing, I think the Q4 is going to be beat by probably 1,000 barrels post-acquisition. Yeah, exit rates probably beat it by 1,000, 500 to 1,000. I'd say 1,000 or more, based on the wells that were drilling, where they were at, and the way the new wells have come online, and putting a risk factor to that already. Yeah, so it's 10 to 14% share dilution. I don't know. I don't have the exact number in front of me, but the FCF did end up being accretive very marginally. I will say that, very marginally. It was not like this crazy accretive deal. But what I really like is the upside potential on these assets and the fact that they're low decline, because they become your base. Along with the Sparky and the Frobishers, they become a base asset that you then get cash flow out of to then put into Mount Bastion assets, to put into the Doig assets, to put into Shaunavon, and other exploration, multi-lat Sparkies and whatnot, as opposed to everything's declining at 20+%, and you need to keep putting money into capital. Everything works at $80 to $100 oil, yeah. So what differentiates Surge assets? A great question. So what differentiates it is you look at what Whitecap is selling in Southeast Sask. You look at what Vermilion is selling in Southeast Saskatchewan. You look at, for example, any Viking play that's up for sale. So, not Pine, the Carve Viking, the stuff that got bought from Rolling Hills and whatnot. This stuff has a limited life to it. That production is blowing down. You are going to lose 10% production every single year, even if you keep drilling and doing new technologies. There are certain things that can be done to mitigate this, but it's not as obvious because the recovery factors are way higher. Your recovery factor is 18, 20, 25% already. So now it becomes more expensive to produce this oil for a longer period of time. When you take these assets in an early phase, when people are still figuring out how to get the oil out, and you have the oil in the ground, it puts you at a distinct advantage to a more beat up, mature reservoir that's been exploited with other technologies. And that's really the gist of what makes this more exciting than any other play. And there are other plays with high original oil in place and low recovery factors. This is not the only one. It's the one that I understand the best. It's the one that I have the best relationship with management. It's one that I like the upside on the multilaterals because I think they're becoming a huge deal going forward. And I like assets that haven't been capitalized since 2014. So when you have these assets sort of rotting away and now they become attractive, I like those assets as opposed to assets that have been so far still being capitalized. So like the Viking and some of the Bakken and even some of the Cardium that just continually gets capitalized, even in a down cycle. You don't have this upside potential on those sorts of assets. Yeah, maybe it's a Windows issue. I'm not sure. I've sworn against Apple products, so I gotta apologize for that. But yes, I will try and get the problem fixed because I think it has to do with as soon as I start the video is when it bugs out. The Westcan drilling results, I don't have the latest information. My discussion with management was that the well is online and we will get the results as soon as the well is stabilized. They told me this last week was when the results were going to be announced, and nothing. So still waiting, waiting for stabilized flow. I think that's what they're waiting on. They probably don't want to release a number that's a one-day number or like the production spiking up and down as the clean out phase happens. So once that's out, I think the news will be out and we'll get a lot more clarity. I still have all my shares and they did finally enter my brokerage. So I do see them free trading now. Haven't sold a share. I invested in this thing for the drilling results. So I'm going to wait for the drilling results and another multilateral opportunity, which I'm very, very happy with. What is your personal top 5? So my personal top 5 are on the website, whitetundra.ca. If you scroll to the bottom, or no, they're sort of right at the beginning. They have the White Tundra portfolio has the top 5 and in fact all the holdings. And those are my top 5 that if I had new money, I would go and sort of allocate that to for a bigger portfolio. Paul gave his word of no bank debt by year end. Yeah, I don't think they're going to meet that. As far as I understand, the way that the deal is structured, I don't think they're going to meet that. And I'll let him face the music. He's going to be on Twitter Spaces probably early December, and he gave you his word on Twitter Spaces, Dennis. So I'll let him deal with that. It's his sort of job to prove that. And you know, sometimes things change, and I understand that. But at the same time, some shareholders have a certain expectation of companies, and he's got to make it clear what his goal is going forward. Because yeah, I think that's part of the problem. It's not that the asset wasn't good, it's that the messaging around it may not have been the best. Yeah, so I like to pick things with a bit of debt. I don't like the debt-free companies. I don't think that's a good way to run these companies. I think a little bit of debt is good. So if you look at my top 5 on the White Tundra portfolio, Surge, Meg, Crew, Obsidian, and Tamarack all have a little bit of debt. They're all growing production a little bit. They have these value levers that can be pulled. They have conventional production. If not conventional, they have huge undeveloped acreage in the case of Crew. They have exposure to multilateral drilling, all of them, other than Meg, obviously, and Crew. They also have other sort of assets that are being left behind, and they have huge original oil in place. That's what I bet on. I'm not all that concerned about debt at this point in time. Yeah, thanks, Trav, for sure. So that's actually a rental. I'm thinking about getting my own. I've been wanting a Corvette C8 here for a while. I just can't find the right one. There was one that showed up in Phoenix, and because of the way the market is right now, by the time I packed my bags to go there the next morning, the guy called me and said it was sold. So there's these points and parts of the vehicle market that are like over demand and undersupplied. So yeah, I look forward to sharing that good news shortly here. In the meantime, I'll keep renting V8 Mustangs and burning lots of gasoline. Yeah, sure, I can talk about Vermilion. I think poor messaging, poor communication, not very clear what's happening. They might have had to shut the share buyback off because of the arguing against the windfall tax. Fair enough. And they're not going to tell that in the news release because you and I read the same news release that the European governments would. So that would counteract the same point. So maybe we can read into it, maybe we can't. I did get a good explanation on the decline rates. Somebody had reached out to IR and sent me the response. Not a good response, I'd say. You don't see 30-40% decline rates like that in a year. A little strange. That being said, I am ready to pounce on an equity position. I don't think Ireland's going to go ahead with the windfall tax. I really don't think so. The Netherlands, yeah, probably. Germany, yes, likely. But then Germany also understands the business cycles, the economic activity, and other things. I think the Dutch are just going to go and find them or do the windfall tax. So that is baked in to my calculation. But Ireland is sort of 50-50. I don't know if they'll go ahead with it. This country is very business friendly, very business friendly. There's a reason a lot of headquarters are in Ireland, in Dublin, I believe. So yeah, I think the jury is out. And if I can get some shares, 22, 23 bucks Canadian, I think the risk reward is just fantastic on that. I mean, anybody that can prove to me with facts and data that the European energy crisis is going to be solved in the next 5 years, I'm open. My phone number is on my website. My email is on my website. My personal phone number is on the website. So if you think there's a way you can prove to me that Europe solves this problem in the next 5 years, while competing for LNG with Japan, with other countries, at the same time, the American shale production is unknown where it's going to go in the next 5 years, shale gas production. And at the same time, world gas demand rises by, call it 10, 12 BCF per day, per year. I'd love to hear it because that's your bear case on Vermilion right there. Will share price depend on the company being able to attract institutional investors? This was something that was told to me, like if they get to $1 billion, then the company would get more institutions and whatnot. So I honestly don't even really care because it's going to happen either way. And I'm not in surge to sell it at $1 billion market cap, like at $12. I'm in this thing to get, 17 was sort of my initial target. Now that this deal has happened and I've done all this due diligence, I'm thinking 25, 27 bucks a share is like, I can just sit there and be my anchor on the portfolio. It can sit there on 50% margin and just stay there. The dividends pays the margin interest, and in the meantime, I just chill out, let them do their thing, and capitalize the plays, prove out the oil. So, okay, Tanner, are you excited about Razor results this Thursday? Yes, I did increase my Razor portfolio weight. I'm not really even looking at the results, to be honest. I've sort of said this before. This is a 2 to 3 year play, and it's just sitting there. I like the upside on this, and amongst other various junior companies right now that I'm really focusing on. So yeah, I did buy that one. I did buy some other ones as well, and trimmed my Meg, I believe, got trimmed a bit in the last month. And the latest portfolio is out, the November 12th version on the website. So yeah, I can't say I really focus on it on a day-to-day basis. It's more of a long-term thesis on some of these names. Same with the other ones that I added, Rock Resources, Avila. You know, it takes time. None of this happens overnight. This is not like building an app where you can throw 1,000 people at it and then the thing gets built. Like, it takes time. It's a real physical thing that you have to do. So yeah, patience, just patience and time are my biggest friends right now. At least I believe so. Yeah, promise no bank deposits. Yeah, maybe I don't even know, but I will mention to them that we want them on in December if possible, and yeah, it should be interesting. They can answer the questions. It's not my job. I'm not an investor relations guy for them. Sounds good. I will let you know, Greg, for sure. Yes, right. As long as the banks are not forcing them to hedge, I think I'm okay with it. If I see any hedging restrictions being put on, not really going to be happy. In fact, not going to be happy at all right there. So yeah. So burn all the coal from Australia. European problem solved. Fair point. I'd like to see it happen. I'd like to see Europe go back to coal for the majority of their power usage. It's just going to be the funniest thing. Yeah. Yeah, the nice thing about Crew is that they're not impacted by blueberry. So a majority of their lands are outside the blueberry nation problem. So yeah, I've been hearing for 2 years that this blueberry nation thing is going to be solved and that they can't miss a drilling season. I don't know. I honestly don't know. That's why I just don't even care. Like I didn't buy anything within the blueberry nation lands. I don't think any of my names are in the lands other than that small slice of Crew that remains. Yeah. Yeah, you bet. Okay, so there's some questions here on this Slido. So what is your thought on Obsidian? Obsidian is very similar thesis for me as Surge. I don't know it as good, but it's a very similar thesis. The Viking, you have the heavy oil, and then you have the blue sky, clear water, as well as some Cardium upside. So just letting them do what they do, low decline, high netback production. The reason I like Obsidian is because it's a growth company. So Surge is not really growing organically, maybe 3 to 5%. Obsidian is growing 10 to 15%. So I wanted something that's growing into a bullish, structurally bullish cycle, heavy oil, and Obsidian was the name. So if Obsidian wasn't growing, I'd just be all in Surge. But because Obsidian offers me that little extra catalyst that if oil prices do hit 110, 120, and you grew 10 to 15%, it provides an extra little boost. Desulfurization plants, all old. Yeah, so I'm not talking about the gas sulfur, I'm talking about the oil sulfur. So that's usually at bigger oil refineries. So Pieridae is not going to be building things like that, but you're right, Pieridae does have a lot of sulfur processing capacity, and sulfur is selling for a lot of money. It's I think it's being used in fertilizers, and just kind of like strange stuff happening across the commodity market. Like sulfur used to be this junk product. You had to pay people to go and dispose it somewhere. And now it's selling for 100 times that a price. Just strange. And that's why I'm in Paraday as well. Valuation plus the upside on these things. So is that PetroNinja shotgun spray type well pattern? Yes, that's always multilateral drilling. Yes. No, Yengera is not a multilateral drilling. No, Yengera is a horizontals that are way too close together. So watch for the main point being one point, and then if it juts out in a cone shape to multiple horizontals, that's your multilateral. Canacol, I don't have any information on Canacol. I dropped it from my list because they got everything hedged out, and I just don't have any insight to add on that company. So I just sort of yeah, I just don't know it. How do you decide which formations are good for water flooding or CO2 flooding? So it has to do with the permeability of the rock. So what's happened here? There's two of them. Okay. So let me see here. So when you look here, your permeability of the reservoirs, which is a natural tendency of fluid to flow, has to be high enough that you can send water properly through these reservoirs. Any of the unconventional frac stuff is not going to work. And even in the Bakken and the Viking and the Cardium, it only works in certain formations that are a bit more, a bit less tight of a rock. So that's really your easiest way to tell. The CO2 itself only works in sandstones and in carbonates. So as far as like exactly where it works, I'm not going to pretend to know. But the reefs are really good. It usually works better with light oil. So CO2 is not going to work in like a heavy oil sparky play. You need a lighter oil with a lot of permeability, and basically oil such that the CO2 can enter the oil and make it more flow, grab it from the rock and make it easier for it to flow, is where it's going to work. So tuning fork flooding doesn't work with multi-leg verticals, right? There is no multi-leg verticals, as far as I know. So on the multi-leg horizontals, tuning fork does work actually. You would just put in an injector leg between your producer legs, and in fact, I think it works really well. I think that's what Tamarack's using right now. I don't think there's any multi-leg verticals right now. Excuse me. Based on current free cash flow yields and drilling results, would you sell Yengera? Yeah, I can't really answer this question. It's going to be construed as investment advice, but Yengera has some really good wells. The recent drills they did drill three or four or five really good wells. The rest were not good. So it all depends on your view as to, can they fix the problem or do they still not understand what's happening? Yeah, but that being said, I really like Spartan Delta and Crew. I think they each have really good upside on both the free cash flow and the net asset value and the land value in general. So I'd rather be in the Montney than the Cardium. You can kind of see I don't have Cardium exposure right now because I just find other places more attractive right now from a long-term development standpoint, as opposed to a current free cash flow standpoint. Yeah, and yeah, I know, like the ARC Resources, I just sold it. I was getting tired of what was happening there, and nothing was getting fixed. And the well degradation, as I talked about earlier, right at the beginning of the presentation. Yeah, I don't buy dry gas stocks, so I'm not interested. I've got my Crew Energy to play the LNG, and that's about it. I don't want more exposure to the Montney. I don't want to use a shotgun approach on the Montney. It's just not going to work. I think picking the one or two best companies and concentrating in them is going to be better. And that's how I play it. And other than that, I just don't like high decline production in a supply chain inflation environment, high supply chain issues, high inflation environment. I'd rather have low decline conventional assets, especially as I see this as a much longer cycle than maybe a lot of people think. So yeah, and I love water floods. I love low declines. I love CO2 upside, which shale just doesn't have. Okay, very interesting. I will check that out, Zendoc. I was not aware of that, so that's good to know. In the cardium too. Okay, good to know. Thank you. Yes, thanks, Abbas. Always great to see you on these. Yeah, I don't really have any potential takeover targets right now. I know there's deals on the table already. There's a lot of stuff still for sale, and there's deals happening behind the scenes that are going to get made public here shortly. And some of the deals are between private companies. So some private companies have decided, look, we can't sell, so let's just get bigger. Let's just go and acquire all this private stuff out there. And it's happening. And some of it doesn't even make it out into the news. It's sort of surprising, but goes to show how opaque the industry can get at certain times. Other than that, I'm not really looking at any takeover plays. I think it's still gonna take a little bit of time. I think the Montney might be the next consolidation, and then as Tom McInnes sort of mentioned, the East Duvernay might get interesting at higher oil pricing. So Artis, Vesta, some of the Paramount stuff, maybe a Baytex, CPG, and even Journey and Kiwetino had a bunch of land there at one point. Yeah, I got no real update on Gear. They're doing what they're doing and paying their 9 to 10% dividend. They're doing exactly what they said they would. So as far as upside on it, I'm not really interested in buying debt-free companies. I don't understand that way of running these companies. If I'm paying you millions of dollars a year to manage a company and you're telling me you can't do it unless you have no debt, it's just strange, right? Like it's, I don't have confidence in management teams that are like that interested in going into a zero debt situation. My opinion, that's my opinion, because I treat the risk differently in these companies than maybe a lot of other people do. I've lived through, or I've invested through a cycle where companies carried like a 50% debt to equity ratio. So now you're saying you can't do a 20% debt to equity or a 10% or a 15%. You have to go to zero and net cash. I understand the mindset around it. I understand that it appeals to a lot of investors and institutions. I get it. It just does not appeal to me. Yeah, no, I'm just going to sell the Vermilion options. I'm still betting on a colder winter here in the next month, and watch people panic as the storage decreases much faster than they thought. If it doesn't happen, I still get about a 350% is what I'll end up making from when I bought them last November, December. So still very happy. I was looking to bag a 10x. I was up to about an 8x when Vermilion was $39 there earlier this year. So I don't think I'm going to get back there, but hey, at this point, I'm just going to let it ride. I think there's a low end to Vermilion around 23, 24 bucks, where literally the collapse of the world is priced into Vermilion at that point. So yeah, I'm going to let it ride and sort of see what happens. And I love buying these options early and sitting on them for a year. And there's a couple of really good opportunities to do that right now. Really, really attractive opportunities, and the option premiums are not that bad. If I wasn't playing, or if I wasn't invested in the junior companies so much already, I think you would have seen me layer on a couple of options there. But I got too much exposure to the juniors right now for me to go into options more. Yeah, I like Crescent Point. I'm very happy with the way their management has done a 180 on the messaging. They have a lot of tax pool. Do they have to make an acquisition? Maybe. Will they make an acquisition? Probably. So if you can get into CPG right after that, because the hedges roll off in Q4, could be very interesting one. Yeah, they've increased their dividend like 5 times in the last year. So I'm not all that concerned about no more dividend increases, but yeah, they've got a $2 billion undrawn line of credit or something like that. So they could go out and make a huge splash, huge splash. Like who would they buy? Would they buy the East Duvernay? Would they buy the Kaybob? Would they buy? I think they're down in Saskatchewan and all that. So yeah, maybe they go and buy the Shaunavon. They buy Surge's little 1,000 barrel per day pool in the Shaunavon. The optimal debt level is completely up to you. Companies used to run 1.5 times debt to cash flow. Now they're running 0.5 debt to cash flow. And I'm happy with that. 0.5 times debt to cash flow. Yeah, that's pretty reasonable, but not at $40 oil, at $80 oil. Yes, I think that is a pretty reasonable number that I can expect them to manage. And I'm in some companies that still have 50% debt to equity ratios. So it doesn't concern me. It really doesn't concern me, because you need to have a good view on the macro first, and then you invest in oil. If you're investing in oil stocks and running simulations on $20 oil and $500 oil, it's not the optimal way. I'll just put it that way. In my opinion, get a good beat on the macro, where you think things are going, and then you decide your companies based on that are set to benefit at those macro sensitivities. Just picking companies and saying, is this going to go bankrupt if oil goes to 30? You're wasting your time for the most part. Yeah, thank you, for sure. I don't run my own oil wells yet, but some pretty interesting news coming on that front shortly. So I've always wanted to buy these wells. I've been trying to buy them since February, March. Yeah, so I'll leave it at that for now. Yeah, I don't really want to say which options they were, but I'll just say that there's a couple options that are like Vermilion, that you have a very high floor, high ceiling built into these options at current share price. So look at companies that have some unique exposure. So Vermilion had the European gas, which I had figured was going to be a problem this year. The pricing was going to skyrocket, and there's 2 specific other companies that have this little catalyst, buying options 12 months out. I'll put it that way, not 3 months, but buying like a December or like a January 2024 option while that catalyst sort of happens. Yeah, I think I want to end it here. There's lots of questions still coming in, which I always appreciate, because I love talking oil. I could talk oil, yeah, 24/7, 365. Okay. Yeah, I think it's going to be more volatile. Like the next month, I'd say the next month is going to be a low activity period. A low activity period means lots of volatility. It's a really good time, in my opinion, to position. Think about which companies you think are going to outperform their peers at whatever macro you believe in, and position accordingly. And then the next year oil market is not going to be the 2021. It's not going to be the 2022. It's not going to be the 2020. It is going to be the slow and low grind up. And certain companies will benefit from funds flow. They will benefit from execution of what they said they would do. And companies that made deals might do better if the price goes higher. So it's just a great time. I'm repositioning my portfolio a bit as I want it. I'm looking at some junior names still, and the volatility is going to be good. It's going to be as it is. And if you're a trader and you think you can make money off it, yeah, by all means, this is the industry to right now be in, because the volatility is like a sustained volatility, right? It's not like the broad market where things go up 1,000 points and then the next day it's down 1,000 points. It's completely unpredictable volatility. Whereas with the oil market, you can play these ramps over a week, and then a fall over 2 weeks, and then a ramp over 3 weeks. It's more of a sustained trading pattern, which is great for traders, and it's great for investors because it gives you opportunities to buy things cheap if you have the patience to kind of wait, if you're willing to let things go, let's say, and you have a plan B, a plan C. I think it's a great time. It's the rest of the year. That's my plan, is really pick the good ones. I have a lot of meetings with management in the next 3 to 4 weeks, before the Christmas holidays sort of start, and making sure I understand what's happening, making sure I see any opportunities, and allocate accordingly. Yeah, I like both Crescent Point and Whitecap for different reasons. Whitecap doesn't have tax pools. If Whitecap had tax pools, I would be buying that company day and night, options as well, multi-layering different kinds of options, but they don't have the tax pool, at least not the NCL, non-capital losses. So I like them both. I'm not going to pick right now one, CPG or Whitecap. One has better acreage, more reserves, but they have the tax problem, which is a 23% cut right there. So yeah, well, I think we're quite a ways into this, so I'm going to end it here. But I'm actually surprised this was one of the most attended sessions, given how technical it was compared to the other ones. But really appreciate everybody joining. The questions are always something different, always something new coming in, and I love talking the technologies because we can talk macro, we can talk company valuations, but really I've said this many times before. This is an engineer's and a geologist's cycle. I think people who understand assets, people who understand the companies, what they're buying, and themselves what they can go and buy and make money off of, is just fantastic. It's just such a great time in the industry, both from a investing perspective or allocating your own capital and going and doing different sorts of projects and deals and whatnot. Yeah, it's just great. And yeah, I hope to share here more of what's going on behind the scenes shortly here. There's been lots of activity, lots of interesting things, lots of opportunity that is still out there. So with that, I will say goodbye, and we will see you for this week. See what the week brings, and continue the conversations on the Twitter Spaces and everything else. So thanks again, and have a great rest of the weekend and a great week ahead here.